Yes, sir.
ಲೋಕದ ಡೊಂಕ ನೀವೇಕೆ ತಿದ್ದುವಿರಿ? ನಿಮ್ಮ ತನವ ಸಂತೈಸಿಕೊಳ್ಳಿ, ನಿಮ್ಮ ಮನವ ಸಂತೈಸಿಕೊಳ್ಳಿ. ನೆರೆ ಮನೆಯ ದುಃಖಕ್ಕೆ ಅಳುವವರ ಮೆಚ್ಚ ಕೂಡಲ ಸಂಗಮ ದೇವ. ವೆರಿ ಗುಡ್ members. Ravindra Koreyer, Chairman of Bangalore branch of SRC of ICI, the wholeheartedly welcome you for the 83rd Jnana Dasoha live webcast program from Bangalore branch. Today, as I mentioned yesterday, it was a 6 hours program. The 3 hours yesterday, it's been spent by already CA Narendra Jain and Mr. Adarsh Rati. The continuation with from yesterday, the today's sessions are computation of ALP section 92C, Rule 10B, Rule 10CA, the economic adjustments, selection of PLI. The speaker is CA Vaishaka Bhat. On behalf of all the viewers and managing committee members of Bangalore branch, I wholeheartedly welcome CA Vaishaka Bhat for the today's session. Welcome you, Vaishaka Bhat. Members, it is a 3-hour session today, 4 to 7. The next part of the session is on designing search strategy and TP documentation with case studies, TP certificates, Form 3 CEB issues and precautions going to be handled by the renowned speakers and experienced personalities in the field, that is none other than CA Ganesh Krishnamurthy. On behalf of all the viewers and managing committee members of Bangalore branch, I wholeheartedly welcome CA Ganesh Krishnamurthy for the today's session. Welcome CA Ganesh. Along with Ganesh, CA Hiranmay Ganesh is also in this session on behalf of all the viewers and managing committee members of Bangalore branch. I wholeheartedly welcome Madam CA Hiranmay Ganesh for the today's session. Welcome you, Madam. Dear members, as yesterday I mentioned in my speech, transfer pricing, it is a new area. It means not new area. Many members are not concentrated into this area. Yes, we have to make an attempt, because yesterday after the sessions, many members are asked me for the that video. We have already uploaded yesterday's video into our YouTube channel. So that was the hungriness for the our active members. The Bangalore branch members are always active. The bank not because of members, the branch become active. So I wholeheartedly welcome all the viewers for the today's special session on transfer pricing. Dear members, the coming to an next week sessions, we have planned in 2 sessions. Next week, 25th, we are having a planned exclusive Tally Prime product showcase by Mr. Shanmukha is going to take through us all the updates of Tally and how, because the now remote edit is an important tool and the many updates have come. So that session we have planned. And 26/11/2020 we have planned an IBOR transition, what it means and why it matters. Speaker CA Mangrish and CA Asha M going to handle on 26th November. This November month we have already, this is a 8th session and another 2 sessions is planned on 25th and 26th. Kindly view all the program of Bangalore branch. Dear members, yesterday also I mentioned from tomorrow the Bangalore branch is totally busy for the supporting the examination department of ICI, making arrangement for the 41 centers in Bangalore and 4 centers around the Bangalore, and the many second line cities have been opened the centers in Karnataka. The branch, Bangalore branch, is supporting for the examination department. Our motto is to let this examination should be conducted successfully. So with that note, I wholeheartedly welcome all the speakers for the today's session and all the viewers for the today's session. I request our Bangalore branch Chikasa chairman C. Panindra to formally introduce all the speaker for the audience. Over to Panindra.
Thank you, Kore sir. So first session is handled by CA Vaishaka Bhat. So Vaishaka is a practicing chartered accountant with an overall experience of 12 years of experience in the area of direct taxation, including transfer pricing. She has worked with EY and also on various tax and regulatory areas with specific focus on international tax and transfer pricing matters. She has also worked on various controversies resolution, prevention options such as mutual agreement procedures and advanced pricing agreement. She currently handles projects involving cross-border structuring, transfer pricing modeling, transfer pricing documentation, cross-border and documentation and domestic advisory, tax compliances, as well as litigation. Her experience includes involvement across industries such as technology, automobile and automotive, financial services, real estate, pharmaceutical, healthcare, and many others. And she also speaks on taxation in several forums, including ICI. So with this brief introduction, I welcome CA Vaishaka Bhat for today's session. Welcome you, ma'am.
Thank you.
And coming to other speakers, so well-known, renowned speaker, CA Ganesh Krishnamurthy, sir. So he is a director with tax and regulatory practice of Pricewater PwC LLP and has overall 15 years of experience in assisting global and Indian MNCs on tax, transfer pricing, value chain planning, structuring, audits, litigation, and competent authority processes. And again, one more speaker, so colleague of CA Ganesh Krishnamurthy. So CA Hiranmayi Ganesh is a fellow member of ICI. She has working experience in assisting various multinationals in transfer pricing compliances, including benchmarking, value chain analysis, advisory assignments, audits, and litigation across automotive, manufacturing, IT, and ITES sectors. With this brief introduction, I once again welcome all the speakers for today's session. Welcome, welcome all the speakers. And also, as our chairman sir told, like from tomorrow we have a CA final exam, intermediate exam from day after tomorrow. So due to COVID, there are so many rumors also spreading like whether COVID test is required. So as clarified by exam department, there is no COVID test required. So only if the student is having COVID, so then they are not allowed to write the exam. So please inform your articles who are writing the exams. And all the best on behalf of Bangalore Branch for all the students who are writing. And over to CA Vaishaka Bhat for today's session.
Thank you, Parindra sir. Thank you, Kore sir, for that kind introduction. Charles Darwin had said in the long history of this, human history, that those who collaborate and those who improvise more effectively only will prevail. So thank you so much for the Bangalore branch to giving us this opportunity to collaborate at such a difficult and challenging time. And of course, amidst the greater challenges now that the institute is facing with the exam logistics as well. Thank you once again for this opportunity. So I'm just trying to share my presentation. I hope it is.
Yes, ma'am, it is visible. You can make full screen.
All right. So I hope you all had a very engaging session yesterday. And as Kore sir was telling, we are going to continue and take off from where we left off yesterday in the transfer pricing discussion. With that, the topic we have for today is computation of the arm's length price, economic adjustment, and selection of PLI. We have about an hour and a half to cover this topic. In case participants have any questions, I would request you to post it in the Q&A tab. To the extent, I see the questions and it is relevant for the topic that we are discussing, I will try to address it then and there. Otherwise, we'll take a few minutes at the end of the first session, which is at the end of 1.5 hours from now. And I'll try and address some of your questions to the best of my ability. So as we discussed, the topic is, what we have today is section 92C. Just to give a perspective of how the regulations and the framework of the regulation is, we have in this slide the whole host of sections under the Income Tax Act that talks about the TP provisions, as well as the corresponding rules that is provided for in the income tax rules. We have the main section which talks about how to compute the ALP. I believe y'all would have covered the basic provisions relating to the Indian TP regulations as to when it's applicable, what is the definition of international transaction, when will two enterprises become associated enterprise, etc. in the prior sessions. So we will focus on section 92C, which tells us or gives us a guidance on how to compute the arm's length price, and the corresponding rules, which is a rule 10A, rule 10AB, a part of rule 10B, and then rule 10C and rule 10CA. So we will look at a little bit more in detail in the coming slides. As a precursor, this topic essentially forms the majority part analysis, what we call as the economic analysis. So this is where the crux of the whole the computation mechanism and the analysis required to draw a conclusion whether a particular transaction is at arm's length or not is coming from. Each of these points, each of these areas itself is an ocean, and we can take days discussing it, but I'll try my best to sort of cover at a broad level all the relevant topics under this segment, just to give you a flavor and hopefully, pike interest to probably study this or learn this further in your practice. Before I could go into the section, I just wanted to quickly set the context. So when we talk about a transfer pricing or a transfer pricing analysis, depending upon at which point in time of the transaction I come in as a transfer pricing professional, I would wear a different set of hat, right? Just to clarify the different nomenclatures that are used in the transfer pricing context, and to better understand our next few slides, I just thought I should take a few minutes to discuss this. So we hear about in a transfer pricing discussion that what is a business model. We would start with understanding the business model of a group, and then there is something called as a transfer pricing policy or a transfer pricing remuneration model, and then there is something called as the transfer pricing method. So all these three are really different. It denotes or it refers to a different set of items. What is a business model? Business model is essentially the model how a company or a group in its commercial wisdom has decided to run the affairs of the company. We will take a very simple example to understand the difference between the three. Let's say there is a US company with predominantly US based customers. So the business decision to target only US customers is already taken. That has no role for a TP professional to play. So it's a US company with US customers. In order to better deliver, strategize, and optimize cost, as we have all seen in several of the fact pattern, the US company sets up a offshore center in India and decides that a part of the delivery function has to be undertaken and provided by the Indian captive entity. This is the business model wherein the US company becomes the principal or the entrepreneur, which is undertaking the predominantly significant economic functions and undertakes the relevant risks. The Indian company is set up as a delivery center. So what could be the transfer pricing policy in such a business model is that because transfer pricing is applicable to such a situation, they might have said that the Indian entity will be remunerated on the basis of all its cost or full cost plus an appropriate markup that is acceptable from an India transfer pricing perspective. So the TP policy or the TP remuneration model here is the cost plus model. But having said that, the transfer pricing method, as we all are aware, that we would historically or we would traditionally apply to sort of establish that the transaction undertaken by this Indian company with its US companies at arm's length would be a transaction net margin method and not the CPM as a TP method that is prescribed under the rules. And that is for several reasons. So a CPM or a cost plus method as a pricing policy need not necessarily determine what my TP method is. An alternate example would be this offshore center could have had a pricing policy of a hourly rate for the purpose of billing, but my TP method could be TNMM for me to defend the transaction. So this is a fundamental difference. If I was involved in the transaction at the first stage, I would probably be advising the company as to within the commercial framework, what are the key ingredients for them to set up the business model. You would have seen a little bit of this in the yesterday's discussion, which my good friend Adesh Rati had discussed on, as to how manufacturing setup could be in the form of a contract manufacturing model or a toller, etc. Or in the case of a distributor, you have a full-fledged distributor versus a limited risk distributor. These are the business models that are generally prevalent in this context. What we will focus on today is more from a transfer pricing method. That is, the transactions have happened. There is a policy which is already in place. I am coming at the year end to see either as an auditor or as a person to test the transaction at the year end, or to defend the transaction that I have undertaken and evaluate whether that has been undertaken at arm's length or not, having regard to the framework provided by the law. So, like I said, we are at that last leg, which means typically the scope of my work would be to do this transaction or do this analysis on a post-mortem basis. Just to clarify, it doesn't mean that I cannot do this TP analysis as prior to undertaking a transaction. That is not the point I'm trying to get to. But we are going to be focusing more on how do I apply the methods and apply the adjustments in the economic analysis portion of my analysis to a transaction that has already been undertaken. Therefore, with a limited flexibility of to change the mechanics of the transaction itself. Therefore, when I come to a TP analysis, typically these are the areas which would be covered in the transfer pricing documentation as I write it. I would first review and understand the nature of the transaction, international transaction undertaken between the two group entities. And then I will have to understand what the company does, a little bit of overview about the group itself. I will need to understand the industry in which this group operates to get a sense of, where this particular activity is sitting in the whole value chain. Then I would undertake a FAR analysis, that is functions, assets, and risk analysis for both the Indian company and the US company in our earlier example. At the end of the functional analysis, the conclusion that I would draw at the end of a FAR analysis is to sort of give a characterization to these entities which are engaged in the transaction. And that is where I would give some kind of a risk profile, whether they are bearing a limited risk or it's a high risk entity, or is it an entity with normal risk that is comparable with the rest of the players in the market. Once this happens, now I know the transaction, and for that transaction I have concluded on the FAR. Now is when I'll have to decide which is the method I will apply to defend this transaction that has been undertaken. Depending on the methods I choose, in certain instances, there will be relevance to choose a tested party. Tested party is on whom I'm going to perform the analysis. And then I'll have to decide on what is the profit level indicator. This is again relevant in a margin-based analysis. That is to say, if I'm comparing my profits with the profits of other comparable companies, what should be the denominator? What should be the base for measuring this profit? what is the data I can take? How am I supposed to identify and collate data for this particular exercise? And finally, basis that data, how do I finalize my list of comparables for the purpose of measuring that arm's length price? Then, of course, once I have the set of comparables, they are not going to be 100% fit. There might be some differences between the nature of terms and conditions that I have versus the comparable company. So what is that adjustment that I could undertake and finally determine the arm's length price? Basis that arm's length price is where I will test my margin or price or whatever is that I'm testing and come to a conclusion on whether it is at arm's length or not. So in between, of course, one of the key part here is on this data collation itself. How do I, where do I get these information relating to the comparable companies? So we have a whole host of database and there is a search mechanism which by convention and with the help of the database service providers has been established in India. I think we will have this discussion by Mr. Ganesh in the subsequent session. So just to summarize, the points in blue were more or less discussed yesterday. We will touch upon a little bit on the transfer pricing methods today and cover the points in orange for the rest of in the first 1.5 hours that we have. Okay, so let's start with the section. The section is a very, has a simple framework. Just cutting through all the clutter, all that it says is for an international transaction or a specified domestic transaction, you compute the arm's length price by using any one of the prescribed methods, having regard to the nature of transactions, the functions performed, and other relevant factors. So this is a section which tells us and lists down the prescribed methods that we are supposed to apply, or the only methods we can apply to determine the arm's length price. It goes on to say that such method that you select has to be the most appropriate method, and how you choose the most appropriate method go based on the manner prescribed for choosing the method, and this is again given in detail in the rules being 10b and 10c. Then it says, so then the next what the section does is, as a taxpayer you're supposed to do this, but it also gives the power to a tax authority to say AO may proceed to determine the ALP, that is arm's length price, in the same manner as as how you and I as a taxpayer would have determined. In the same manner, AO can also proceed to determine the ALP after, of course, giving an opportunity of being heard, etc. If based on information and documents that is available with him, he is of the opinion, okay, it's enough to form it be just as an opinion that the price charged by the taxpayer is not at ALP, or he is not adequately maintained some documentation with respect to a particular transaction, or he has failed to furnish the transfer pricing documentation when asked for, or if the AO believes that the information that is used by the taxpayer to determine this ALP is not reliable or correct. So of course, this is where the AO gets the power to determine, but how he will have to do this, the procedure that he has to follow, the timeline within which he has to do it, and the fact that he has to refer the matter to a specialist transfer pricing officer, all that comes in the subsequent section, and that is not the scope of the today's discussion also. It's just for us to know that the same rule and the mechanism that is available for us to compute ALP is also available to the AO to redetermine or to verify in case he is not satisfied with what we have done. To that extent, there is some kind of a significance attached to this exercise as to why our analysis has to be robust, reliable, and clear in terms of why a particular method was chosen and why that was the best method. So what can happen if AO computes the ALP, which is different from what we have done? The section says that he could go on to compute the total income having regard to the by replacing the transfer price that the taxpayer has done with the ALP that is determined by the AO. But after he does that, on such enhanced income, a deduction will not be available under section 10A, 10AA, 10B, chapter 6A, etc. Also, if there is an income of the AE, let's say, on applying the arm's length price by the AO in a certain transaction, and if that there was an income arising to an AE on which tax was deductible or deducted, replacing the ALP here will not automatically mean that the AE will also get the benefit of that. Let's understand, this last point maybe with an example. So here is a case study. We are told here that there is a B Inc. which holds about 27% equity shares in A Limited. That is to tell us that B Inc. and A Limited will qualify as associated enterprises. B Inc. provides certain know-how to A Limited, for which A Limited pays a royalty of about 10 million to B Inc. A Limited, on payment of this royalty, has deducted taxes at 10% by applying the treaty benefit and has remitted the balance 9 million to B Inc. Now, because it's a royalty and it's taxable in the hands of B Inc. also, both of them have filed a return. The position in the return is as follows. So far as A Limited is concerned, so there is another business that A Limited is running, for which it has obtained this know-how. So the profits from such business without the royalty expense is coming to 300 million. They've claimed the benefit of the royalty expense. Net profits was 290 million because it was eligible for a tax holiday. It's taken the deduction 100% and there was no profits that was taxable in the hands of A Limited. B Limited has filed a gross based return by just showing its royalty income, and because there's a TDS of 1 million already, has taken the benefit of that 1 million and had no further tax paid. Now, what has happened during the assessment proceeding? The AO has proceeded to compute the ALP of A Limited for the royalty transaction, and has said, no, you shouldn't have paid 10 million, you should have only paid 4 million, because based on the information available with me and based on the analysis I have undertaken, the arm's length royalty should have been only 4 million and not 10 million. So what does that do? So the same example, the first column indicates A Limited's position in the return. Under the assessment proceedings, this 10 million is getting replaced by 4 million, which is adding about an additional 6 million profits to tax in the hands of A Limited. But because of this section, A Limited cannot claim the tax holiday for the enhanced income, and therefore will have to pay taxes for the 6 million on one side. On the other side, now that A Limited has been told only 4 million is the right amount of royalty or the ALP, B Inc. cannot automatically say that only 4 million was subject to tax. Therefore, give me a refund of the balance. So this is essentially the consequence if the ALP determined by the AO is different from the ALP determined by the taxpayer in its documentation. Just to, of course, it's an oversimplistic example, but just to give a perspective of why it is important to do the transfer pricing analysis in the right manner in the first instance. Interestingly, this kind of a embargo on the tax holiday applies only for only when the enhancement has happened or undertaken by the AO and the AODRP during the assessment proceedings. There are decisions which has held that this will not, in case of a voluntary adjustment or an enhancement that the taxpayer does, either on account of, let's say, a safe harbor, a MAP, or a APA proceedings, and because of that, a taxpayer has offered additional income to tax, uh, the tax holiday should still be available because the bar under 92C4 is only when the ALP is determined by the AO. So going back to the 92C, we said, so it said it had listed out the methods and it told us to choose the most appropriate method. I'm sure we all are aware of the that is prescribed under the law. It is the cup method, resale price method, cost plus method, profit split method, transaction at margin method, any other method. Each of this method has its own uses, its own applicability, advantages and disadvantages. I hope you would have had a discussion on when what is relevant and how each of these method is applied in yesterday's session. So once I've evaluated the method, like going back to again the 92C, it said you choose the most appropriate method for the particular transaction. And how do I choose the most appropriate method? That is something that is provided under Rule 10C. 10C tells us in very clear terms how or the guidance that is provided for determining the most appropriate method. It's so the first it says the most appropriate method shall be that method which is best suited to the facts and circumstances of each transaction, and it provides a reliable measure of the ALP. So, so it should first suit the facts and circumstances of each transaction, and then also that method should give me the best possible measure when it comes to determining the ALP. What are the factors that one would keep in mind while choosing the most appropriate method is also provided in the rule. So just to elaborate further, what does it mean that it is best suited to the facts and circumstances and that it provides a reliable measure? I want to just take a small example here. So either from yesterday or from your own practical practice that or from the various controversies that is available is typically this debate on what is the best method for a royalty transaction, whether it is cup or a transaction net margin method. And now what I want to say is that there cannot be one best method for just one class of transaction. It really depends on the facts and circumstances of that transaction. So to elaborate further, let's say an Indian company has a know-how arrangement with a foreign company and it is making a royalty payment at the rate of 5% on the net sales that is sold by the Indian company. So now the pricing mechanism is that it is 5% of net sales. So of course, for a transaction of this nature, cup is more suited than a TNML for the reason that when it comes to cup, royalty is one line item in the P&L, and I am trying to establish the arm's length price qua that one line item. Whereas in a transaction net margin method, I'm looking at the net margin, which could be a function of several factors, including the sales and other expenses, which really has no relevance or link to the royalty or to the intangible that the Indian company has obtained from its foreign AE. So at a broad level, it is one could conclude that cup is the best method here. Now, when is it the best method? When I'm able to find comparable companies also having similar pricing mechanism. That is, I have to be able to identify adequate comparable transactions where they also have the measure as royalty paid as a percentage of sales. Then that is a reliable measure. Then I compare the two, and we say that it is, whether we come to a conclusion whether it's at arm's length or not. Now, let's say if that such a measure was not available. Typically, percentage of sales is something from practice. I know, or we know that we will get transactions if you go look for it in the right kind of a database. But what if the Indian company had a royalty arrangement wherein it was paying royalty based on X amount per unit sold, right? Let's say it is like 10,000 for every unit of product sold is the amount of royalty that the Indian company has decided to pay the AE. Now, how would we test this, right? Ideally, if you have to apply a cup, you need to get data which is uncontrolled. So basically, on the assumption that an internal cup is not available, you need to get data that basically gives you comparable uncontrolled transaction, which also has a pricing arrangement in a similar fashion. That is X amount paid per unit. So in that case, that per unit, so the goods has to be, or the product that the comparable company and our tested party is selling has to be so close and so close to one another for me to be able to apply cup here. So in such an instance, I think because the data may not be available or it may not be reliable, you may not be able to use cup itself as a method. It will not provide you a reliable measure to come to the arm's length price. Therefore, you might change your conclusion to a transaction net margin method. Because the royalty payout, I'm not able to have a reliable measure to compute the ANP. So then therefore coming to some of the factors. So coming to some of the factors that shall be considered for selecting the most appropriate method. I have to see the nature and the class of international transaction. So this is pretty straightforward. What is the transaction nature, whether it is a purchase of goods, or is it provision of services? Is it payment of royalty, interest, etc.? Then I need to understand the nature of the class of AEs, nature of AEs, and their FAR. So in most circumstances, we think this is a one-sided analysis. I just need to do or understand the FAR of the Indian company. But no, we'll have to juxtapose it to the entire value chain. We also need to understand the FAR or the level of functions and risks and assets of the AE also. That would also help you decide which is the better method. Coming to the third one, the availability, coverage, and reliability of data. So one is the data should be available. In our earlier example, if I had a royalty payout which is per unit, unlikely that kind of a comparable data is available. Second is coverage. So your client might say that, oh no, but I know somebody else who's also having similar terms. He's my competitor. You can use that data. So that is essentially a cherry picking. That it is not a broad coverage, right? We just have one or two cases that one is aware of. You can't just take those to do the comparability, or for that matter, use that in determining the method. Largely the reliability of data. The reliability of data could be seen in two ways. One is it should be like available for others to also see. Mainly, I would look at this as a verifiable data. It has to be a data that can be verified by anybody who's checking or testing it. Degree of comparability, again, a very, very important factor in choosing the method. As we all know, the degree of comparability should be very high for a cup, but a relatively lower for a TNMM. We will probably discuss this a little bit in detail with examples as we proceed. Lastly, how much ever you take the best of the comparables, there is always bound to be some kind of a difference between the tested party and the comparables. Therefore, while you choose the method, we also have to factor in, can those differences be offset by some kind of an adjustment in a most reliable manner? If those differences cannot be equated, then that method may not be the appropriate method. Lastly, the reliability, of the assumptions. We do this at the end of the day in this analysis. A lot of judgment calls, uh, a lot of assumptions made by one person, because it is not entirely a black and white kind of a situation. So the method which probably has the least amount of assumptions, uh, or the reliability of assumptions where it is slightly better, that will be the method that one would choose. So at the end of the discussion, the point is that there is no hierarchy of methods. It's not that one is better than the other. It really depends on the transaction, the facts and circumstances, availability and reliability of data, and the extent of adjustment one can make to ensure that the analysis is robust. In the same breath, where we talked about Rule 10C to sort of looked at the features or the guiding factors for choosing the most appropriate method, that exercise is not something that we can do independent of the exercise that we would undertake to undertake for the comparability analysis itself. So what I mean by that is, whichever method you apply, at the end of the day, the data that we take, whether it was internal or external, has to be comparable to the tested parties transaction. Even though we have these guidance provided under two different rules, which is 10C for choosing the appropriate method, and 10B gives guidance how I have to undertake the comparability analysis. But in a sense, both have to be looked at together, because only when I know what kind of comparability analysis I have to do, that will also decide or depend on the method that I have to select. So from that perspective, let's also quickly look through what Rule 10B has to offer before we probably look at some live examples. So 10B tells me first, in the sub-rule 1 gives me a description of application of various methods. It clearly gives like a brief guidance on, if it is cup, this is how you have to, this is the steps you have to follow. If it is RPM, these are the steps you have to follow. You may have had an overview of that coverage yesterday. Then once you've taken the method, now I have to take comparables. Once I have a method, how do I choose my comparables? It's also something that's provided under 10B. They say you look at the specific characteristic of property transferred. So if you see, it's more or less similar to what we saw under the guidance for choosing the most appropriate method. You look at the FAR of the respective properties, parties, you see the contractual terms. This is again a very important point. You see the conditions prevailing in the market. That is by the geographic location of the other AE. What is the government laws or the regulatory framework that is there in that jurisdiction? How is the economic situation of that AE jurisdiction, be it in terms of the labor cost, cost of capital, level of competition, the extent of economic development? And again, the most important guidance from a comparability perspective is the level of market. That is, am I serving a wholesale market, retail market, or what kind of a market situation that I'm in? That also becomes very important in coming to a conclusion on the comparables that I finally choose. Then the rule, of course, recognizes and asks you to ask a question whether the comparables you have chosen, do they have some differences that's going to materially affect your price or the cost charged? And if which will be the case in most circumstances, it's impossible to get kind of apple to apple, as we say. But you also have to answer, can I make some reasonably accurate adjustments to eliminate the effect of these differences in the terms? And that is what we will see further under the economic adjustment as we proceed further. The last point that 10B talks about gives you a guidance on what kind of data, which period of data that you have to take to do this comparability. we will come back to it a bit later once we go through the, the comparability aspect itself first, and we'll come back to the guidance on the period of data. So I do see some questions. There are some. I think there's some with specific fact pattern. As I said, let me take some of these at the end of the presentation. I hope that is fine. So with this framework, right, we understood the methods and then we understood the comparability requirements. Let us just quickly go through some of the methods, and I'll try to talk about few examples that may be relevant as we in the practical example that may be relevant, or how one would view it as we look at these methods and the comparability requirements for each of these methods, and what could be that economic difference that are very critical under these methods, and maybe have a quick discussion on to see if we can sort of do some kind of an adjustment to offset that difference. Cup, of course, as we know, is like actually the more direct method, because there is the focus is on the transaction price itself. That is, if you have an import of a particular product, and if you're able to get the data for import of similar products in an uncontrolled situation, it's as direct as a comparison one can get to. But what it is very sensitive, therefore, to the nature of the product itself. That is, it has to be the similar product. I cannot even compare a Reynolds pen with a Parker pen, even though both are pens, right? So there is a huge difference in the quality of the product, the market, the positioning, the brand, etc. So if I have to compare a pricing for import of a Reynolds pen, assuming there was a related party transaction, it has to be with something that is similarly placed product. Even though Parker is a pen, we cannot compare. So that is the amount of degree of close connection that is required for cup. Conditions would mean the key terms and conditions. That is your quantity, whether what is the shipping arrangement, FOB, CIF, with warranty, without warranty, all those conditions. There a credit period. All this will go on to directly impact the pricing. Therefore, when I establish comparability, I have to be mindful that these are possibly the factors that I have to take into account before I can choose cup as the best method, and thereafter choose that particular data as the comparable data. Therefore, coming to what could be the differences that may make or break a cup analysis. One is the product quality, like the way we discussed Reynolds versus Parker. Contractual terms, same thing. If I have 1,000 units imported from AE, and if I have to compare it with a one-off 10 units imported from a non-AE, can that be comparable? The answer is no. Therefore, you'll go on to see if that volume difference can be something that I can offset and make it into a comparable segment. A level of market, this is to do again with the retail and wholesale. The price at which I would sell in a wholesale market would be different from the price at which I would sell in a retail market. Therefore, that is a difference that I have to recognize, that I can't take the data blindly, but also see in what way we can offset that difference. Date of transaction, again critical for cup. If I'm comparing a transaction undertaken with the AE today, the data cannot be a 3-year, the comparable data cannot pertain to 3 years before, or even for that matter, even the prior year. Then foreign exchange, it is to say that if one transaction is undertaken in INR and the other is undertaken in Forex, obviously there is a difference, but I think this is a reconcilable difference. You could see, you just eliminate the realization or the income or the loss that is arising due to the forex fluctuation and make it neutral in terms of the currency, and thereafter you may be able to compare subject to these other parameters being comparable. Moving to RPM, RPM looks at the gross income, that is it measures at the gross profit level. Therefore, it's not so sensitive to the nature of product. So here, if I'm a taxpayer who's engaged in distribution of pens, so RPM as a method is applicable when I import from my AEs and sell in the local market. So possibly here, one could take an argument. It doesn't matter if I'm comparing it with the distributor of a Parker pen as well. It is not necessarily true in all the situations, but possibly it's fine. It is less sensitive to the product difference. As long as it's a product group, it should be fine. Because what I'm trying to compare here is the measure or the margin that one would obtain for undertaking a distribution function with a particular level of assets, functions, risks, right? But of course, therefore the function is important, whether I'm undertaking that similar distribution without any value addition. If there is any kind of a value addition, or if there is a different market that I am targeting, then it may not be comparable. So what are some of the indicative differences? Of course, the inventory level, if the business or if the nature of the product or the business was such that for one, the level of inventory had to be very high vis-a-vis another, then that is a critical point for difference, because these things, so inventory level will directly go on to the funds locked in the business, and therefore there is a higher working capital cost for that particular business vis-a-vis the entity without the inventory levels. That would directly impact the pricing of the product, and therefore the margin that one would expect, and therefore is a difference that one will have to evaluate and make a adjustment. Here again, one point I want to make from a appropriateness of the method perspective. So we all know that RPM is appropriate for a distributor. That is, if there is a taxpayer who's importing, as I said before, importing from an AE and selling it in the local market without any value addition, that is when RPM is better. You measure at a gross margin level, you don't look at below the gross margin. The concept or the funda being, my AE transaction is only till the gross margin level. As long as that measure is comparable to an uncontrolled price, what I do below the line should not matter. When I say below the line, below the gross profit level should not matter. Indian company without being influenced by the overseas entity, right? So, but having said that, it doesn't mean that all distributors could potentially have RPM as a better method. And this is where, your FIR comes into picture. Let's say we did a FIR for a particular entity and we came to the conclusion that it is not a normal distributor, but it is a limited risk distributor. A limited risk distributor by definition means undertakes very, very limited strategic functions. It enters into contracts, it supplies to the person in the third party market. But all the key decisions relating to this sale, supply, and distribution is something that is dictated by the group entity. To that level, if you see, there will be an influence that the AE will have on the amount of OPEX that the distributor would spend. So typically, we've heard of this issue of AMP. If it is a normal distributor, he's a guy who will say, okay, as a group, as my AE, you have this product. I will buy from you, sell it in the Indian market in the best way I see it. So decision relating to pricing, marketing, positioning of the product, advertisement, everything is taken by the Indian company. But if there was another company which relied heavily on this marketing strategy, brand, etc. of the overseas entity, then you can't still say RPM is the best method, because in most of these cases, practically what happens is my marketing budget is also set by the overseas entity. So I'll have to necessarily go to a transaction net margin as the appropriate method. The example I tend to understand better for this context is, for the first example is let's say something like a Cadbury chocolate, right? Even though there is a common brand, but the way it is positioned in the Indian market is very customized to Indian market. If you look at the ads, or there's a slogan which is based on Hindi, etc. It is customized to the Indian market. So one can say that those expenses have been incurred by the Indian entity based on its own marketing and branding strategy. Compare that with something like an Apple iPhone or anything. That's a global brand. The brand is already recognized. There's nothing much that the Indian company has to do to be able to get customers in India. Plus, the whole brand strategy is globally driven because you have a uniform logo, you have a uniform saying, uniform advertisements that is used across. Therefore, giving the impression that even the marketing budget or the sales branding budget is something that's dictated by the AE. In such cases, I wouldn't go for a RPM basis method for testing it, but a transaction net margin method, because therefore I'm factoring in all the OPEX when I'm comparing the margin. CPM again is it's a measure on the gross income. While RPM was applied on the sales, CPM tends to apply it on the cost. It is predominantly applicable for an entity which does limited value addition on certain goods or supplies a semi-finished goods. Again, not very popularly used in the Indian context because of the difficulty in obtaining this data relating to the gross margin on the cost, right? So here what we are saying is, there is a product, I want to measure the margin on all the direct cost incurred in supplying that product. It is very difficult to get the reliable data in a third-party context as to how much was the direct cost in manufacturing the product, or in let's say even providing that services, and how do I eliminate indirect cost. In the absence of that level of data is where the popularity of this method is weak. And that brings us to the most popular and the main method, the more and it's not it's for a reason why it's the most popular method, because it is less sensitive to product difference, less sensitive to any of the differences in the contractual terms, risks, nature of functions, product portfolio, etc. Because at the end of the day, I'm looking at it at the fag-end, at the net margin level. And therefore, several of the differences that could be there will be ironed out by them. Secondly, data availability is better here because we do rely on publicly available information, and therefore such data is available. I don't have to do much adjustment. I don't need to decide or look at what is direct cost, what is indirect cost. I just need to look at the operating cost level, which is something that is visible from the face of the financial statements, and hence the most popular method for many international transactions as we have seen it. Profit split method is actually a more, as of course global consensus is also increasing, it's more accurate method, because here in order to evaluate my transactions, I am not looking at some external party. I try to look at the value drivers within the group and look at what was ultimately the group has a particular level of profits. We are only talking about splitting that profit with all the contributing entity based on the value drivers. But it's still not very popular for a couple of reasons. The taxpayers may be hesitant to use this method because this would involve the taxpayers opening up their global financials and books to tax authorities across the world. Second is there's a lot of judgment involved, right? How do I establish what is the value? How do I establish the value contribution undertaken by each of the entity within the group? It's very, very subjective and it involves a lot of judgment call, because of which it's not as popular as it should be, but otherwise a more accurate measure of ALP. Just a simple case study, just to put this in perspective, the what we talked about in terms of the product the comparability and the terms being comparable and the ability to do the adjustment to the difference, etc. Just so that we understand it in the in the context of numbers, I have this. It's again an oversimplified example. If information of this quality was available, cup is always the easier method to apply. So we have A Limited and B Inc., which are associated enterprises. What we are told is A Limited supplies about 10,000 printers to B Inc. at 20,000 per unit on a FOB basis, and it is not providing any warranty. A Limited also supplies about 1,000 printers to C Limited, which we are told is an unrelated party at about 30,000 per unit. Please note it's a higher amount, uh, but that is on a CIF basis and it is also providing 1 year warranty. A Limited has been able to determine its cost of freight and insurance per unit, which is at 5,000 per unit. It has also determined the cost of warranty per unit, and it attributes about 200 per unit towards the bulk trade discount, because that is the volume or the contract terms that we were talking about. To A Limited, it is supplying 10,000 printers, but to C it is only 1,000. So I need to adjust, right? Obviously, I would have given a price discount to B Inc. because he's buying 10,000 printers from me. So we have all this data. Because there is this data, and so the first step is I have a product comparability. We are assuming here that it is the same printer which is supplied to B Inc. Is also supplied to C Limited. Therefore, and there is the internal data itself. Therefore, I decide internal cup is the appropriate method. And then while I recognize there is a difference in the cost relating to the warranty and the CIF FOB, and the fact that it is the quantity is different, I've recognized all that. I've found out data relating to that, and I'm trying to make an adjustment to that price. So 30,000 is what I've sold to C, but I'm supposed to make the adjustment by reducing all these costs before I can come to the arm's length price, which will be the actual price I'll compare to test it with my transfer price, that is 20,000, which is a price charged to B Inc. After doing this adjustment also, the arm's length price is coming to 22,300. Therefore, the difference, if any, I make will be only with respect to the 2,300 rupees. What else, we would look at in this kind of a situation before maybe going ahead and concluding that cup was the right method? Some questions that one could ask is there a product difference? That is, even a difference in the model features would make a difference. Example, say, let's not say printers, let's say some other product, same fact pattern. What if the product supplied to C Limited was under a patent, right? It might be the same category of product, but the product supplied to C was under a patent, but under a B it was not under a patent, and that would make a significant difference in my comparability. Then I cannot take this data as a starting point. Next comes geographic market, again relevant. If one is exported to US and the other is exported to Indonesia, there is a bit of a difference in the purchasing power, in the ability to pay, etc. So we will have to take that into consideration before we take this as an appropriate method. So So we have a long example to discuss this a little bit more in detail, but in the interest of time, I will skip it for the time being. We will come back to this if we find time after we finish discussing through the contents of the slide, and we've had the time to take some of the questions. But that example was more in the realistic fact pattern, how a typical company would have similar, I would import some certain components, I would import certain finished goods from my AE, I would have a local market sale, I would have an export sale, I would have some royalty payouts, I would have some interest payouts, there could be some third party purchases. So I just wanted to put that whole thing in context and see what could all be the possible combinations that one can have in coming to an evaluation. But that might take 15 minutes by itself. So maybe we will come back to it if time permits. So continuing with the rule 10b, so that leaves us to this last part now, right? How do I choose the data in order to undertake the comparability analysis? That is also provided, a framework is provided under rule 10b, read with rule 10ca. We will quickly go over it. It is not, it's pretty self-explanatory if one has read or gone through the rules and is accustomed to the practice, but for the benefit of all, I'll just maybe quickly run through it. So what the rule tells us is, if you are applying RPM, CPM, if you are applying, if the most appropriate method that you have chosen is cup, profit split method, other method, then you only have to use data relating to current year. Current year is defined as the year in which the transaction is undertaken. Only that data is permitted for you to undertake the comparability analysis. So example of this is what we discussed a bit earlier. Let's say I have exported these printers in the current year, in that A Limited has exported the printers. If that data relating to sale to C was not also in the same year, then I cannot take that data. If it pertained to a prior year, I cannot be relying on that data. Then the cup as a method also may fail, going back to the other requirement that data should be available in the first place. So for these three methods, I look at data. This is only for comparability purpose. To even take that particular transaction as comparable, that uncontrolled data should relate to the current year of my analysis. If the method that is chosen is RPM, CPM, and TNMM, I can take the data relating to current year for comparability. If current year data is not available, then I can go back 1 year prior and take that data. So what does this mean? In a typical TNMM context, I will look for the latest year data, right? If that is available and it is, then I decide based on that data whether it's comparable or not comparable, and I take that. In case for some reason the latest year financials is not available, then you go back 1 year and check on basis that information whether that is comparable for you or not. One interesting thing that the rule also tells here is, while of course this data availability is something that you and I can check only until we file the 3CB tax return, etc., at the date of undertaking the analysis. But the rule permits data that became subsequently available during the assessment proceedings also to be used to redo the whole analysis. We will understand what this means with again an example, but just one point of reference, this is only to undertake comparability analysis. This has nothing to, this is not akin to a single year data or a multiple year data kind of an analysis. This is to say, for me, let's say if XYZ is a potential comparable, to even take that as a comparable, I should have that current year data should be comparable. I should have the data relating to the current year, check that, and then take it as a comparable. If not, I go one year prior. So what does that mean? Let's look at some examples. Let's say one particular observation, so the current year is, we take, if that is the current year is T minus 1 is the prior year, T minus 2 the year prior to that. C means it is comparable, NC means not comparable, but NA means not available, okay? So C means it's available and it's comparable. So let's say in the first observation, we have data is available for all 3 years and it is also found to be comparable, so I will accept it. In another observation, it says the current year it's available and comparable, good. Second year also is available and comparable. Third year is not comparable, no problem, I can still accept it. But of course, when I do the multiple year weighted average, I'll have to only take the year when it is comparable. In the third observation, and the current year it is available, it is and found to be comparable. But the second year it is not comparable. Third year it is comparable. Still okay because of based on current year analysis, this company was found to be comparable. So I accept it. But for the purpose of the weighted average, I take the years only where it is comparable. So it's like that. This will get clear in the observation 4. The current year itself is not comparable, right? So I have the current year data, but it is not comparable. Then I reject the whole company, irrespective of the fact that the earlier 2 years it was comparable. So this is the point of difference that I was trying to explain for. This analysis is to check for comparability itself. If my current year, based on current year data, if that was not comparable, then I reject the whole company. Observation 5, slightly different from 4. In 4, it was available and not comparable, therefore I had to reject. But in observation 5, it was not available only. So I can go back to the earlier year and check for comparability. We found that it is comparable, therefore I've accepted for the weighted average, I will take the T minus 1 and T minus 2. Observation 6 tells us that it's not available in the current year, but therefore I go back 1 year earlier, it is comparable, therefore I can accept the company. Look at observation 7, current year data not available. So the rule permits me to go prior year, so I go prior year. Prior year, I notice that it's not comparable, right? I have to stop there. Since it's not comparable, it's rejected. Even though T minus 2 is comparable, I can't take it because I am not allowed to look for T minus 2 as a data for the purpose of doing the comparability analysis. So I hope this is clear. It just puts down, it's just unnecessarily complicated rule that we have under the Indian regulation. This was not how it was before the amendment to the Rule 10B and therefore applicable from, I think, financial year 14-15. Now, what is the significance of this ability to take the data when it becomes available during assessment proceedings? So let's just take this observation 5 and observation 7, I think, right? So in observation 5, I have accepted the company basis of its comparability in the year T minus 1 because data for T was not available at the time of filing the return. Let's say that data becomes available at the time of assessment and year T becomes not comparable. Then that status of that comparable will go from accept to reject because current year data is now available and it is not comparable, I'll have to reject it. Likewise, observation 7, we have taken the status as reject based on the fact that T minus 1 was not comparable. But say assessment proceedings T becomes available, then if T becomes available and it is comparable, then I have to take that company because based on current year data, it is comparable, right? So that kind of a difference in my set itself can happen just by data being available at a subsequent point when the assessment happens. So then it goes on to say, which is this is the rule 10 CA. It says now, so from this, right, your data set is all the accepts that you have on the last column. So the ones which are rejects, which is observation 4 and 7, is not even there in your data set. Based on this comparability analysis, you have now created a data set for taking it forward. Now, the fact that you have 5 observations in order to be able to compare it with your tested party transaction, it means there is more than one arm's length price. In the earlier example of cup and printers, it was not complicated. There was only one observation. So I took it and we were able to compare. Now there are more than one observation. So what happens? It says that you construct the data set by placing it in ascending order. Then where you have multiple years, you compute the weighted average. The rule also goes on to say what will be the weight that you will apply depending on the method. If it is RPM, it is on sales. If it is CPM, it will be on cost. TNMM, it gives you based on cost, sales, assets, or any other base. We'll come back to this later, but typically this weight could more or less be linked to the profit level indicator that one will choose. Then it says your ALP will be the one which is placed between the range, the quartile range of 35th percentile to 65th percentile. If the method chosen is cup, RPM, CPM, TNMM, and the data consists of 6 or more entries, which means the range concept is not applicable for a PSM and a other method. It is not possible to apply also because in a PSM and other method possibly yes. In a PSM you'll just not have multiple data like that. The analysis, the approach to analysis itself is different. But let's say other method, let's say it is a guarantee and you have got, or let's say it's an export, you want to apply that method based on certain quotations. For theoretical purpose, let's say we have multiple quotations. We cannot get the benefit of the range. You have to apply only the other method that we will come separately. So the concept of range, that is 35th to 65th, can only be used for cup, RPM, CPM, TNM, and if the data set consists of 6 or more entries. In all other cases, you will use arithmetical mean for determining the arm's length price and the traditional approach of using the tolerance band or the variance from the transfer price, which is 3% and 1%, to see if the transfer price is at arm's length or not. Some examples to understand this little better. So I have 7 comparables here. I have the data for 3 years and which is operating profit and operating cost, and then we have computed the weighted average. So till here I hope it is clear for everybody. This is all based on comparability. I have collated the relevant data. Now the rule is telling me you place this data in the ascending order, right? So I place the same data from 1 to 7, but these comparables are rearranged, right? Here it is A, B, C, D, E, F, G, but it is rearranged in the ascending order. Then I compute the 35th to 65th percentile. How do I compute? 7 is the total number of observation. 35% of 7 comes to 2.45. It's not a whole number. Yeah, the rule says when it's not a whole number, take the next value, that is a higher value, which becomes the third place, and the value of third place is 8.2%. Likewise, for 65th percentile, I'll do 7 into 65%, which places it at 4.55. Again, not a whole number, so I take the next whole number, which is 5. The value at the place 5 is 10.57. So my range, arm's length range, therefore falls between 8.2% to 10.5%. Uh, we can also compute, we also need to compute the median. Median basically puts the midpoint of the whole range. For that, I take 50%. So 7 into 50% gives me 3.5. Since it's not a whole number, I take the next place, which is a 4, and therefore it comes to 9. Now, what does this mean? So I have a range of 8.2 to 10.57% with a median of 9%. Let's understand what do we infer from this. If the tested party's price is uh, at 9%, right at the median, or let's say it is between the range, right, 8.2 to 10.5%, then we conclude that it is at arm's length because it's within the arm's length range. What happens when it is outside the range? The outside the range could be of two nature. One is above the higher range, other is lower than the lower range. So when we have 12%, which is above the outer range, it is more than the 65th percentile. So there, what the rule tells us, your arm's length price in such an instance is the median. It is not you can't call the range as the arm's length price, right? So the arm's length range is 8.2% to 10.57% if the tested party price is 9%. But if tested party's data is falling outside the range, then median becomes the arm's length price. So I would conclude that 12% is at arm's length because it is more than 9%, which is the median. And I will conclude 7% is not at arm's length because it is less than the median. I just like to take one question. Somebody has asked in the initial example that I took why the CPM was if somebody is compensated on a cost, if a captive service provider is compensated on a cost plus basis, why would you apply TNMM rather than the CPM? So I think I subsequently covered that point. CPM looks at a gross margin analysis, while the methodology may be correct in terms to say for a service provider who is only doing part of the service or the work in the entire value chain. That is, Indian company does some work, gives it to the US company. US company adds more value to it and then gives the customer. Factually and in terms of its applicability, CPM is the right method. But when I do the comparison, I need to be able to test the margin at a gross margin level. That is what was my direct cost of doing that work and the markup that I earned to before delivery. Which literally means I have to able to get the direct cost plus markup. Even though I'll have that information for tested party, I won't be able to get that margin, get that data from a comparable company's perspective. Example, in a service context, the predominant direct cost is employee cost, but in the financials, only employees will be there. From that, I will not know what were technicians, software developers' fees, how much was HR fee, HR cost, finance team cost, etc. There's no way I can make a reliable adjustment to come to direct cost looking at a third party financials, and therefore we predominantly reject CPM as a method while testing such captive service providers. Okay, we look at, so I will just summarize this is again, it's just a variation to computing the arm's length price. That is that if in the earlier example, we had a case where when the 35th percentile was computed, it didn't come to a whole number. So we said we look at the next number and take the value as per that. But what happens when there is a whole number? The rule says you take the average average of the values in that whole number and the place in the next. So in this case, there are 20 observations. Uh, 35th percentile puts it on in the 7th place, which is 7, serial number 7, and it has value of 47. But the rule tells you take an average of 47 and 48, which is the next value, and that will be your 35th percentile. So the same approach to 65th percentile and median. This is just specifically given in the rules, so therefore something that is to be followed. Also, please note this case study and the earlier case study is lifted directly from Rule 10 CA because I think that example is the only way to understand what they are trying to say. But that's just a mechanism given under the rules as to how I have to compute it. I'm again a simple case study just to explain how in case 6 data points is not there, what else is the option? That is for me to compute the arithmetic mean and the tolerance band. I will not go into it detail because this is again been there in the provisions for a very long time. Coming to the next topic, which is a profit level indicator. So like, on certain methods where we are comparing margins, the margins is always a percentage of the profits on some other denominator. It is a return on something. It's a return on cost. It is a return on sales or return on an asset employed. So what is that level or the profit level indicator that I use will also depend a lot on the facts, the nature of transaction, and the reliability of that comparability, for instance. Genesis for this, if we look at Rule 10b, where it talks about the transaction net margin, it says the profits shall be computed in relation to the cost incurred or sales effected or assets employed or to be employed by the enterprise or having regard to any other relevant base. So that base that I choose to do the profit or the margin comparison has to be relevant again to the facts. Very, very, very logical approach, but there has been some discussions, guidance available both in the OECD and the Indian jurisprudence. So we will quickly go over it. What does the OECD give us as a guidance? It gives broadly two guidance. One, it says denominator should be the relevant indicator of the value of functions performed. So if I'm a sales entity, then my functions performed is sale, so my return should be on the sales. If I'm predominantly a value adding company, right, like a research and development or a outsourced service provider, my function is to add value. I'm not looking at the sales side of the supply chain. I'm only adding the value, or for that matter, a manufacturing company, etc. So then the cost could be a relevant indicator. So broadly, OECD guidelines gives us these three examples. If it's a distribution activity, you take sales as a base, or distribution operating expense as a base. Now between these two, again, we'll go back to a FAR. I would take sales as a base if that distribution entity is heavily involved in undertaking the sales related functions. That is, that entity has the people functions to go to market, aggressively push for the product, decides on the pricing strategy, product placement strategy, marketing, branding, etc. Then the return obviously has to be on sales because I've done all these efforts to increase my sales. I might take distribution operating expense as the base if somewhere, in that earlier example where I have nothing much to do from a sales front because there is a global network of customer base that is already there. brand that is globally recognized is already there. I am merely just selling. I'm an entity which is set up. I have to stock inventory and sell it. Price also is determined by the head office. In such cases, maybe my return it's adequate if I get on only the distribution operating expenses. That is the value addition expense that I've incurred over and above just to ensure that the distribution happens. Services, we are all familiar. It could either be a full cost or on the operating expense, depending on how it is set up. Manufacturing, again, cost, like I said, because I'm doing a value addition function, my return can be on the cost. In some cases where it is capital intensive, that is if that the deterrent for that particular manufacturing entity was to set up, high-end, expensive, capital-heavy equipment and plant and machinery. Then I've put that money, I've invested so much in that, and then maybe the recurring cost is much lesser because it is all completely mechanized. Then then I would want to measure my return on that capital I have invested in the plant. So then what is the other guidance that OECD gives us? So first one was it should be indicator of the value of functions performed. Second is that denominator should be uncontrolled, right? It should not be a tainted base. When I say tainted, you're at the end of the day trying to see if the profits I've earned from my transaction is at arm's length having regard to the overseas uncontrolled transaction. Then the profit I measure should not be on the same base, which is the tainted element. Example, in a cost plus situation, I get my revenue from AE, so the revenue is the tainted portion. Therefore, I have to take cost as the PLI. I can't take revenue. I can't say this is the profits I've earned, but I'm going to measure it on revenue. But that revenue is what you're trying to test it, so you can't use it. Now, the question may come, what happens if it's like an entity which has both imports, exports, I do everything possible. There are many fact patterns like that. Ideally, you would separate where possible. You would separate it into segments and take an independent PLI, that is, apply your TNMM at a segmental level. But if it is not possible, if that exports and imports are typically too integrated, we could say that take the base which is relatively less tainted. That is, exports is less than, say, the total value of imports, then you take export as the base. Or other sales as the base. Then we have this concept of Berry ratio. Berry ratio is nothing but the measure of gross profit on the operating expense. That is, how many times my gross profit will cover the OPEX is what it tries to see. A simplistic version of this is my profit as a ratio of value added cost. Typically used in intending companies' freight services where I am trying to get the measure of my return only on the limited value addition I do. Let's take an example is Japanese Sogo Shosho companies are again a popular model which uses this method. So these are companies, who trade in high volume, thin margin kind of industry, and they don't even take the inventory risk. Most of these sales will happen on a high C, high C sales as they call it. Even before the entity takes title to the goods, it is passed on to the buyer. So then what happens is I've bought my goods purchased from a related party, sold to an unrelated party, but the goods will directly move on high C, and all these transactions will quickly get concluded. So the effort that the company here is putting is really limited. So they say that the return, if it's measured only on the value added expense, I don't have to add the entire value of the goods sold in my denominator, because it's really going to be like a back. Cash PLI is again a very strange concept wherein some taxpayers say that I will remove the impact of depreciation from my profits if I'm a capital intensive thing or setup, or if I'm in the initial years of operations. If I remove depreciation, then what profits I'm left with is only the, without having the impact of the heavy investment in the machinery or the capital asset. Uh, so the one big question that's always been there is this even a PLI? PLI by nature only looks at changing the denominator as a base, not at the numerator. So I think there was one decision which discussed this, but in India, the jurisprudence has developed without probably questioning further on this. There is whole host of varying sort of conclusions by various tribunals where they've either accepted or rejected. Personally, I do not believe that this will be a good economic indicator for comparability, because depreciation is such an integral part of my OPEX. If there comes a situation where you have to make an adjustment for that, it means you've either taken wrong comparables or you make a depreciation adjustment, which we will come in the next slide as well. That if you think the difference is because I have a higher depreciation because of my depreciation methodology, or because I'm in the first few years of operations vis-a-vis other comparables who are fairly settled in the space, and therefore their depreciation cost is high. You do a depreciation adjustment to bring them on par, but removing depreciation as a whole from the profit element would, in my mind, distort the comparability picture. So I will take up just few questions here, just so that, to give clarity to the questions before I take this last segment, which is on the comparability and the economic adjustment. So there's one question which comes that on the part that I told that, we have to take current year and past 1 year. But the question is, in reality, we use current year plus past 2 years for TP analysis. Why is that? Very good question. And I think that's the point I was trying to stress on, that it is permitted to use the 3-year data when I compute the weighted average, which is coming from Rule 10B, which says that you take the current year and you can take the data relating to prior 2 years, either or both of the prior 2 years, if it is comparable. But the point of discussion that I was having is, how do I come to that data set? That is, how do I choose that particular company is a comparable or not? For that, I can use only current year data and the prior year data. So going back to the example here, so I'm permitted to use the 3 years, so 3 years weighted average, so long as it's comparable. But to decide whether observation 4 has to be a comparable or not, I will check the current year data. If it was not comparable, I've rejected the full company, and that was the point of discussion. I hope that was clear. Let me take up another question. In respect of intra-group services, what are usual documents which would go to prove that taxpayer has discharged its onus of benchmarking the transaction as per provisions of Section 92C? The above question is being asked since the tax department usually makes the TP adjustment only by challenging the need, rendition, and benefit. Can departments claim pay for direct deletion of additions made by them? Interesting question. Again, industry issue. This is happening that most of the intra-group services. So just to give a context to the question, which maybe some of you may not have the benefit of knowing, typically in a multinational group setup, if the headquarter is somewhere outside India, some of the common costs or the management costs, such as business heads, finance head, some of the support functions like administrative, HR, etc., IT, So some of these costs, because it's incurred at a centralized level, they get allocated to each of the group entities, including India, on some basis or the other. And the basis really would be that the group may have some basis. They would have pooled this cost at a group level and they will allocate it to the rest of the group entities. It could be based on headcount, it could be based on the revenue earned by each of the group entities, depending on each path pattern. But what has happened from an India perspective is there is an expense from the Indian entity as a management fee or intra-group services fee, which typically gets disallowed by the tax authority because the method that taxpayers typically follow for this is that the transaction net margin method. Right? So when I'm testing at a TNMM level and my margin is concluded to be at arm's length, so which includes or factors the amount of management fee or intra-group service fee I've already paid. So again, technically, there is no merit in that argument because I might be, a 2000 crore company, but I might have paid a very minuscule amount of management fee. And to say that because I'm at a net margin level, I'm comparable, this is also at arm's length is not technically a right, would not we will not be able to come to a conclusion that it is the most appropriate method. Having said that, practically that's what happens because of lack of the ability to do something else, right? So for example, cup is impossible to apply. Where am I going to get a similar agreement? So each of these intra-group services agreement would be different. It could have services ranging from IT, HR to, group management. I won't have a comparable uncontrolled transaction. So the only way, if you ask me, is to, so therefore, so just to take a step back, the tax authorities have been going on a different tangent to say you prove that you've received the services, that you have benefited from that services. If you're not able to prove, they look at this as some kind of a base erosion payment and therefore delete the whole expenses, giving rise to an adjustment. This has done its rounds. There are high court decisions which have said that tax officer cannot sit in the judgment of a businessman and decide whether or not I should be incurring expense of this nature. Having said that, it's also very integrated, integral, and the onus comes back to the taxpayer to prove why it is at arm's length. In one of the cases, what we did is, again, this goes back to the data sharing. Ideally, the tax officers would be convinced if you're able to show the pooled cost data at the HQ level and how it was actually the basis in which the computation was done to segregate and allocate it to each entity. But most of the time, taxpayers are hesitant to share that level of data because it pertains to headquarters. So in one of the instances, we were able to get a cost auditor certificate who basically from that overseas entity, this was the US in that instance, who gave a certificate saying that the cost allocated to India is based on these principles, and we have audited the numbers and it is fine. So that got accepted and was fairly agreeable proposition, but still at the tribunal level. Indian company A is 100% subsidiary of foreign company B. Only dividend paid to B in financial year, TDS under DTA. So B has to file return for dividend income. What TP method can be used since 3CB stated to be mandatory for this return? I'm sorry, I'm not aware of this mandatory part of 3CB for the return. But this goes to the fundamental question whether a dividend payout is a transaction in the first place. If referring back to maybe the yesterday's discussion you all have had, for a transaction to qualify as a transaction, there has to be two parties. That is, it has to be a two-party transaction. Dividend is usually a voluntary payment by Indian company to the overseas entity. So therefore, you will basically cannot give a basis for compare it with something else. It's my additional profits that I willingly paid to my shareholder, I would take a view that it's not a transaction itself. Which is the best method of pricing for export of software services? It will depend on several facts, but assuming you have a very simplistic captive service provider who provides 100% export to a particular group entity or several group entities. So the question is best method of pricing. So I'm assuming you want to understand the intercompany pricing method and not the transfer pricing method. Cost plus is what is typically used across industry for the reason that it is easy to control and ensure that at the year end I'm still able to meet the arm's length requirement. 100% foreign subsidiary is created to source the business for the Indian holding company. Which method is suitable and what is the margin to be retained in subsidiary before transferring the fund, that is the sales order, to Indian holding company? Okay, it's almost the entire exercise. Of course, we'll have to do several, I might need to understand a little bit more. But the larger issue, as I see it in the question itself, is that if you're setting up foreign, okay, 100% foreign subsidiary is created to source business for the Indian holding company, which method is suitable and what is the margin to be retained in the subsidiary before transferring the funds to the Indian holding company? So basis the question, I'm presuming that the foreign subsidiary is going to enter into contracts with the local customer. Your question is how much should I retain in the foreign subsidiary before they can basically pay back the Indian holding company. It will not be a fund transfer. You need to have an intercompany agreement as to why the foreign company is trying to pay back the Indian company. It will usually be a subcontract of the service or the supply in this case, depending on whatever is the business. Assuming the foreign subsidiary does only trading, that is, it procures customers and it basically subcontracts the entire work to India. You could look at kind of either if it is based on sales, 1 to 2%, or if it's on cost, about 5 to 8%. Depends on which geography, which jurisdiction, etc. But the right way to do it is you'll have to do a benchmarking analysis with the comparable companies in the foreign jurisdiction. In other words, the tested party here will be the foreign subsidiary. How to arrive at ALP when the company is in initial few years of operation, since it may not be making profits or good profits and it will not find comparables at ALP, that may be challenging. A very interesting question. So one of the point I've covered under this slide itself, if you look under others, there is a comparability or economic adjustment that one can do for initial years of losses. But before I maybe explain this further, like in the earlier question, the first question to ask is why is the loss coming? We'll have to understand the conclusion of the functions assets risk analysis that one would have undertaken for this particular activity. And if you have concluded that the Indian company is the more risk bearing and a more complex entity, but the foreign entity was a simpler entity, the answer in some cases may lie in using the foreign entity as tested party and doing the margin analysis for that entity. But if let's say even that was a complex entity and there are several transactions in the foreign entity also, several transactions capital equipment, etc. What you could do is compute the margin for the Indian company based on some projected financials and then compare it with comparable companies. Or typically when we look at a comparability analysis, and I think my friend in the next session would take you through that, we apply a filter called persistent operating losses. That is, if we see a comparable which is not, we see a comparable which is incurring losses over and over for 3 years at a stretch, we typically reject that company because it is not in normal operations, it's not a going concern. But if the tested party is somebody themselves in losses, it may be worth checking those comparables a little bit in detail to see from when they started to make the losses. Is it like a mature company which is having losses, or is that company also in the initial years of operations? Therefore, you'll have a better comparability. Yeah. So in the dividend questions, follow-up question, if it's a preference dividend, should you report? Yes, it's a slightly again a complex question. A preference is a quasi-equity instrument. We will have to you'll have to report, and also the fact that the return for the preference, so usually it will have a coupon rate, and at the time of a redemption there will be a sort of again a capital gains tax. So the analysis, basically what we say is that the arm's length return could come in the way of the coupon rate, which is your recurring preference dividend, plus the upside that the preference holder gets on redemption. So it's again a complex exercise to see at how I ensure that arm's length pricing is done, but yes, you will have to report it. So I think I will stop here considering the timeline, and if that is okay with all of you. And Ganesh, I'm sorry that I've taken some additional time. I thank you again, the Bangalore branch, for this opportunity, and thank you all the participants. You've been very patient and engaging, and I have really had a good time doing this presentation. Thank you so much.
Thank you, Vaishaka. And shall I take it from here? Mr. Panindra?
Yes.
Yes, sir. You can proceed, sir. No problem.
Ganesh, I hope my screen has stopped sharing, right? Your yeah. All right.
Thank you. Thank you. So, dear friends, thank you for your patient listening this while, and I think it was a very, very informative session so far. And thank you, Vaishaka, for setting the context on the methods, and very beautifully explained with a lot of case studies. What we will look at in the next few minutes will be on the the way we do our benchmarking analysis. For example, having understood the various methods in terms of how they are sought to be applied, how do we deal with the data? How do we arrive at the arm's length price? And how does it link with the transfer pricing documentation, which is essentially what gets looked at by the regulators, by the transfer pricing officer during a transfer pricing audit. So my discussion with my friends will be split into two sections. One is to look at some practical nuances of the benchmarking analysis. We will go through a couple of case studies which will help us all understand how these methods are applied in practice. And then the most important thing, which is to do with what are the considerations with respect to form number 3CEB? Within the time that we have, I am not sure whether I can do justice to both these sections, but we will try our best to go through some of the important elements of both of these. And my colleague Hiranmai, who is also with me, will take us through the first part of the session, which is to do with the benchmarking analysis and the documentation. And wherever required, I'll step in. But these are the two aspects we will cover, and I look forward to an interactive discussion. We would urge you to post your questions on the Q&A box as you have been doing, and we will take it up at the at the end of the session. If there are any questions coming up which have to be addressed as we speak, we will do that. Otherwise, we will take it up, if you permit, towards the end of the session. Thank you for your patience, and Hiranmai, over to you.
Hi, Ganesh. Hi, everybody. Parnindra, I'm not able to share my content.
Manish, so can you just make
just enabled it? Can you just try now, ma'am?
Yes.
It is visible, ma'am.
Okay. Yeah. Good evening, everybody. Myself and Ganesh, our topic for today is twofold. I would be covering the first part. First part is designing a search strategy and how we should be documenting it. So the agenda for this part would be, I would quickly take you through the transfer pricing analysis, a quick snapshot on what are the different items which would be there in the for a TP analysis. A quick overview of the comparability analysis and benchmarking, how we should be selecting the data for comparability, and the basic filters that we should be applying, a couple of case studies, and a quick overview of the economic adjustments that we should carry out for a better comparability analysis. So the entire transfer pricing analysis is primarily based on one particular aspect, which is the arm's length price. Arm's length price is basically what it tries to say is the compensation for an intercompany transaction, that is with an associated enterprise, should be at the same level as that of a transaction with a third party or an unrelated party in an uncontrolled kind of a scenario. Typical related party transactions, if you see in a multinational group entity structure, you will have purchase, sale of goods, raw materials. You'll have provision of services, availing and provision of services. You'll have there'll be payments of royalty and technology fees. There'll be typical loan and guarantee transactions between the group. So if you see the different steps that should be covered in a particular transfer pricing analysis, first and foremost would be the group and industry overview. A group overview typically gives a quick snapshot of the entire group, the relationship between the entities, what each entity in the group typically does. And a group overview also highlights on the uniqueness of a product or a service that an entity is delivering. Uniqueness in the sense, for example, in the case of an Apple or a Samsung, they might come up and say that it's a very unique product, and it will be quite difficult to because it's a very heavily R&D related enterprise or an entity. It will be difficult to find comparables in such cases for an Apple or a Samsung. So, trying to understand the group overview will give us a broad understanding of the relationship of the entities within the group. Next one, we look at the industry overview. It tries to give an idea of how the entire industry operates and how a particular entity that we are analyzing fares when looked at with the entire industry. And if you see the group overview and the industry overview, it helps us especially in understanding the qualitative filters. Basically, we have two filters, quantitative, qualitative filters. Understanding the group overview and the industry overview will help us to filter the comparables in a qualitative manner. And also understanding the industry will help us provide a justification for a financial result or a performance of a company. If I can take the example of our recent COVID scenario, when we look at the industry overview perspective, in the COVID scenario, there might be certain industries, say the automobile industry or the manufacturing sector or any industry which is labor intensive. Those industry would have had a problem. They would have had a setback for a couple of months or so. But on the other hand, industries which were well equipped with ITES infrastructure, say for example a Netflix or an Amazon Prime or industries like that, or say an online education industry. In such scenarios, actually they would have picked up their sales and the turnover would have actually increased. The demand for such services would have actually increased during the times of COVID. So understanding the industry overview is very important to see whether a particular company is a comparable or not. Next, we go to the functional analysis, functions, assets, and risk analysis. So basically the FAR. So FAR is basically something which helps us to understand what each entity in the group adds on, or the value creation of each entity in an organization. So based on the functions, the comparability will be determined. For example, if you take a typical distribution model, they would have a high advertisement and marketing costs. So the comparable companies that we should be choosing should be those companies which have a high emphasis on marketing and distribution. So understanding the functions of each entity of the group would be very essential to find the perfect comparables. The next very important aspect would be the characterization of an entity while we're doing the entire transfer pricing analysis. Characterization is typically to understand the business model in which the entity is operating. Characterization, typical business models could be a manufacturer. In a manufacturer, it could be a full-fledged manufacturer or a licensed manufacturer or contract manufacturer. There could be a distributor, full-fledged low-risk distributor, or it could be a super distributor. And a service provider could be a captive service provider or an entrepreneur. So characterization of an entity would be very important in order to compare the other entities. Yeah, and also characterization will be very important because the profit level indicator will come into play. What is the profit level indicator that I'm going to choose in order to compare with my other companies? The next important step would be identifying the tested party within the group entity. Tested party typically would be an entity which performs the least complex functions, which would typically be an entity which will have a very low risk compared to the other group entities. The next, and then finally, after all of these steps are done, we try to identify the TP method would be which would be most appropriate, and finally we come to the benchmarking or the comparability analysis. So broadly, this I just put this on because each and every step has an impact on the comparability or assessing the tested parties that we need to compare with our entity. Ganesh, would you like to add anything here, anything specific?
Sure, Hiranmai. So I think that was very well explained. I would only say that some of the important aspects when we do a documentation or when we write the basis of an arm's length price, often in our interactions with the transfer pricing officers, we've seen that they've not been able to appreciate the basis of selection of a method. And that is because the earlier sections in a report or in a document do not, I would say, pull the string in that direction of the method. So in the example that we were talking about, for example, in a current situation of COVID where certain industries have been impacted, it is important to explain and with empirical data, say in the industry overview or say in the group overview, the supply chain, the factors impacting the industry in a way that when you come to the benchmarks, the thread is very seamless. And a reader could understand why you applied a certain set of filters because you've already explained in your earlier section what drives the business. And that link, I think, is extremely critical. It should not be a siloed approach to a benchmarking. I think that was my key message, Hiranmay. Please continue.
Next, I would like to directly jump into benchmarking. As I said, we do this entire exercise of benchmarking to prove this arm's length principle that we are trying to justify. Benchmarking could be internal or external. Internal comparables are preferred because we have a readily available information with us. Internal comparable typically is when a transaction, when we undertake a transaction with our associated enterprise and we undertake a very similar transaction with a third party as well. So this is something which will be easily defendable with the assessing officers in case of an assessment. It will be easily defendable when compared to an external comparable. And also you can go for, if the internal comparable is not available, mostly it will not be available. If it's not available, we can go to external comparables. A lot of publicly available information is there for comparing external comparables. Rule 10C and Chapter 3 of the Transfer Pricing Guidelines talks a little bit about how the benchmarking analysis should be undertaken overall. So OECD suggests typically a 9-step process on how the comparability analysis should be undertaken. First of all, we need to understand, as Vaishaka also highlighted, on the years that are to be covered for this benchmarking analysis. The current year information has to be available and the prior year information has to be available in case the current information is not available. And then the step 2 would be to basically understand the taxpayer's circumstances. This would be covered in the group overview, industry overview. Industry overview would cover the circumstances in which the entity is operating at. And also, obviously, the FAR analysis, which would help us understand the value creation at each stage. The third step would be understanding the international transaction. FAR, that is the functional analysis, as I mentioned earlier, and selection of the tested party. And then again, as I said, we should be evaluating whether an internal comparable is available, because that is the more preferred method. Or if it's not available, we go to the external comparables. Then we have selection of the most appropriate method. Again, Vaishaka elaborated this in detail on which method has to be applied where. And after all of this analysis, after we analyze each and every step, we come to identifying potential comparables for justifying arm's length. And if at all, we need to also assess at the end if we have to make any relevant comparability adjustments to make the comparable data more comparable to our entity under consideration. And again, finally, we have, after all of this analysis, we'll try and analyze whether we are at arm's length. So basically, this is a framework to justify that we as an entity are within the arm's length, principle. Again, this is a quick snapshot of how the benchmarking as a process works. We try to understand the industry overview, group overview, and the functional analysis. Then we characterize the entities based on the business model. We select the tested party, which is the least complex entity. We select the most appropriate method based on the various factors listed above. And then we go to the actual benchmarking analysis. And if at all we feel that there's some kind of adjustment, qualitative adjustment required, quantitative qualitative adjustment is required, we make that adjustment, and finally we arrive at the arm's length price. These are typically the documentation requirements, which is mentioned under Rule 10D. So basically, we have to document how we have arrived at the uncontrolled transactions, which method we have chosen, what is the analysis we are performing to evaluate the comparability, and what is the kind of adjustment we are making, if at all we're making some adjustment to the financial data of the comparables or to the entity. So broadly, we are supposed to document all of this to justify that, yes, we are in the arm's length, we are within the arm's length principle. Again, Vaishaka broadly covered all the methods, and I'd quickly like to go through each of the methods and where typically it will be applicable. For a cup, the strong similarity of products and the terms and conditions of the arrangement, a strong similarity has to be there, then only a cup will be applicable. A profit split method typically applies where an intangible is involved, and when two different entities to the transaction are equally contributing to the function or equally contributing to the value creation. Resale price method typically happens in a distributor kind of scenario where there is a purchase of good from one related party and then it is resold to unrelated parties. Here the value addition is very less. Cost plus method typically happens in a manufacturing a finished or a semi-finished product or a service, and it is separate to the associated enterprise. TNMM is mostly, if you see, TNMM is a very broadly used method. It examines the net profit. This is broadly used because unlike CUP, it doesn't warrant for a complete similarity of products or services. Even if it's relatively similar, TNMM could be used. And usually it is applied to the party which is the least complex entity as per the FAR analysis. And then finally, we have the other method. For any transaction which doesn't fit into the above mentioned methods, other method could be used. For example, valuation of shares, intangible property, for cost allocation agreements, and for reimbursements. When typically it happens in a cost-to-cost basis, we can use other method to justify the transaction. Yeah, so again, this is a quick snapshot of the comparability requirement, as I mentioned earlier. For CUP, the comparability is very high. That is, the products have to be very similar and the terms of the transaction have to be very similar. Prices are benchmark, and practical applicability, if you see, it's medium. In many of the cases, we might not find exact comparables. As I mentioned earlier, say an Apple or a Samsung or something which is a product which is very, very unique, it would be very difficult to find a CUP. Resale price method, again, comparability requirement is high. Gross margins are benchmarked in this case because, as I said, the value addition is very less in a resale kind of a scenario for a distributor. Practical applicability is low. For a cost plus method, again, the comparability requirement is high. Gross margins are benchmarked here, and practical applicability is low as well. TNMM comparability is medium. As compared to CUP, it doesn't require exact similarity. Relative similarity of the comparables is fine. Here, typically, the net operating margins are benchmarked and practical applicability is high. In most of the cases, we end up using a TNMM to justify our arm's length principle. And for a profit split method, again, medium comparability requirement, practical applicability is quite low. And other method, so any other transaction which we cannot fit into any of the above methods will come under other method. Here again, the prices are benchmarked, practical applicability is high. Ganesh, any thoughts on why we end up using TNMM in most of the cases?
Yeah, very, very pertinent point. And I think, honestly, in my view, when we see a lot of arrangements within a multinational group, I think the world today is much better because in the past, I think the data on internal comparable transactions, or for that matter, even prices, were very difficult to obtain. There were no databases that used to capture this information. And we'll look at the next slide on where, for example, these methods find applicability. But today the data is available and there are more availability of data. So for example, you may see that there may be data reported for customs purposes where price related information may be available. And a very good question, for example, Mitra has raised, where a distributor does an intensive marketing activity. Can RPM be applied? Now, RPM in our earlier slide, we saw that it's applied where there's very little value addition from a distributor. So the question is, a marketing activity is something usual for a distributor to do because the distributor will market the product. But if that is quite intensive, and the level of intensity will depend on the expenditure relative to the sales that is made. So if that level of expenditure or involvement is significant, then one has to question whether RPM will be reliable. We'll have to do the analysis. We'll have to see whether, say, for example, you apply a filter VAE by sales and see whether you can identify similar companies. But to answer your question, Hiranmai, why TNMM is the method? Because, and we'll see in the subsequent slide that given the data that's available, in our law, it said that you have to apply a method and get a reliable and correct result. And therefore, when you say correct, it's not fair, it's correct. So therefore, to that extent, a profit-based method is much more tolerant to functional differences. And that's why you see TNMM being applied. Other method, because sometimes you have information which is, for example, giving an indication on the arm's length price and not necessarily an arm's length price. So we see valuation reports, etc., which give a basis for the arm's length price, which also give an arm's length price, but that's not really a comparable data, but it's close to it. So therefore, you see other method coming into the play. So that's my limited point. And Hiranmai, please continue.
Yeah, as Ganesh mentioned, general applicability, if you see for a cup method, it will be loans, royalty, service fees, tangibles transfer, and guarantee fee. Because typically for loan arrangements, comparable data will be easily available. An entity might have given a loan to a third party as well as to its AE. So relatively, the data will be available. So for typically for these transactions, a cup would be applied. For a resale price method, again, marketing operations of the finished products where a distributor does not perform. Again, as I mentioned, when it's in case of distributor where significant value addition is not done. So in that case, a resale price method would be applicable. For a CPM, a sale of finished or semi-finished goods. For a profit split method, where in case of unique intangibles. And for a TNMM, provision of services or a typical manufacturer or distribution of finished goods and guarantees. And other methods for, say, especially if you take for valuation of shares, for, say, purchase and sale of assets, where a chartered accountant certificate or some other external party's certification or evaluation certificate would be typically obtained to get a justification of the arm's length price. And quickly touching upon the various PLIs which will be used for each of the methods. For typically for a resale price method, gross margin would be taken as the PLI, gross profit by sales, and it is typically used by a distributor kind of a model. Again, I would like to reiterate that the characterization plays a very important role in choosing the method, the profit level indicator, and what we choose as the PLI for the benchmarking of the transaction. Again, for cost plus method, it's gross cost plus margin. Typically for a manufacturer. For a TNMM, we can use either return on total cost or operating margin for a manufacturer or a distributor. For TNMM, we could also use return on assets, OP by VAE, and return on capital employed as the profit level indicator based on the characterization of the entity. Next, I would like to go to the sources of data, from where we can get this comparable data, and selection of the time period. Internal comparables we can understand through going through the group overview, then discussing with the management, trying to understand the entire structure of transactions. Internal comparables can be obtained through that method. And for external comparables, you have various government sources. We have a lot of commercial databases, say Orbis or Capitaline, CompuStat, and RoyaltyStat, to state a few. And we have foreign sources, industry associations, and knowledge of employees. Knowledge of employees in the sense that Many a times when we talk to the entity, when we try to understand the functionals of an entity, they would typically highlight certain competitors, which could be used as potential comparables. So that is what I mean here by knowledge of employees. And selection of time period, when we look at it, Rule 10b-5 states that we should be taking comparables for which current data for the current financial year is available, or the data for the immediately preceding the current financial year is available. So I've denoted it as L and L minus 1. Next, we move on to the basic filters which we might use for performing a search. Yeah, the different types of filters that we may use for a search process is typically a size or a scale. Say, for example, you can take an example of a company which has just started its operations, whereas a company which is well established in the market. A company which is well established in the market would have definitely an advantage of economy of scale, experience. So that would definitely have an impact on the comparability as well. Next criteria, if you look at intangible related criteria, in that case, there might be companies which are typically heavily reliant on R&D, especially in the pharmaceutical industry. They are heavily reliant on R&D. So when choosing comparables, we should keep this in mind, that whether it is a very research-oriented, or we should try and understand the intangibles of the comparables as well while trying to do the comparability analysis. Country of sales. Country of sales, when we look at, each country would have its own set of rules and regulations. Each country would have different customer sentiments. Each country would be operating in a different manner. So that is something very important that we should take into account while doing the comparability analysis. Stock holding, again, if it is a heavily inventory holding entity, there might be a requirement for a working capital adjustment which needs to be made either to the tested party or to the comparable companies. So an economic adjustment might be relevant here. So that has to be taken into account. And other criteria, like for example, there might be companies for which the structure, the entire entity structure would have changed. It would have merged or it would have demerged. There could be a change in the management of the company because of which there are high fluctuations in profits. There could be bankrupt companies. So we need to really understand if any peculiar situation had happened for a particular comparable because of which is reflecting in its margins. And we need to reject those comparables. Anything to add here, Ganesh? Anything specific?
No, I think this is fine. I would just emphasize, for example, on the country of sales. And typically, it all depends on the, as I said, we go back to the, the functional analysis, the group overview. When we write that section, what we write is extremely important. If we are saying that my business or the Indian company's business is predominantly dependent on export revenue, then, and that's an important ingredient to the pricing, because an export market may fetch a very different price to a domestic market. And the considerations could be different in terms of supply chain, in terms of warehousing, the activities that are involved. And that would influence the price. And if that is a key driver to the business, then we will need to get into that driver when we select comparables. So we have to apply a filter, say export sales to total sales for the comparables as well. As much as closer we can get to the comparability, that's a benefit, because then you're getting to a more closer arm's length price. That was my only point on this, but go on, Hiranmi.
Here I've listed down a couple of illustrations for quantitative filters. Sales should be greater than 0 for 1 out of 3 years at least, because considering that it shouldn't be a startup company that we're comparing. Then manufacturing sales versus total sales, or trading revenue from trading activities by total sales could be a filter. Industry filter is very important as well. Whether you're a manufacturer, whether you're a distributor, I think the industry filter would be very important in that sense. Ownership, if it's a government company or a private limited company, that would play a role. Again, net worth. we should ensure that the comparables that we are choosing shouldn't be eroded of their net worth. They shouldn't be having a negative net worth. So that is something we should take into consideration. And sales greater than INR 1 crore could be one of the quantitative filter because again, this is to say that we should be rejecting the comparables which are in the startup stage and net fixed assets by intangibles filter. And again, as Ganesh was saying, export to the total turnover could be a factor based on the country of operation. R&D, a very research-oriented entity we would have to take the R&D filter. Especially for service providers, I think the R&D filter would become very relevant. Employee cost, if it's going to be an employee-intensive industry, we would have to apply the employee cost filter. Inventory filter, and BAE by total sales filter by relevant. When we move on to the qualitative analysis, we would have gone through the group overview, the industry overview, and the functional profile. So based on that, we would have had quite a good idea of what the business of the entity is all about, which would help us narrow down on the comparable companies. And also we could review the annual reports and maybe go to the website of the company to understand what exactly the functions are, functional profile of the entity is. We take this analysis together, and then we look at the other few other qualitative considerations are if the comparable is a consistent loss maker. Again, we have to try and dig deep and see what is the reason for that loss. Again, if our entity is a loss maker, we can try and consider those loss making companies as well. But typically, for a normal entity, consistent loss makers should be rejected. Sensitivity analysis, in the sense that, what I mean to say here is abnormal fluctuation in margins. If in 1 year, say an entity has an OPTC of 10%, and in the next year there is a negative 25%. This is just a hypothetical example. But say there's a negative 25%, we have to look into the entity. So if there's a huge fluctuation in the margin, there's definitely something which has happened in that particular year which has caused that loss. Say there was some very peculiar or extraordinary event which had happened. So in that scenario, we cannot be taking that as a comparable because our results would not give a true picture. Of arm's length results, whatever we are getting from the search would not give a true picture. And then we come to the related party analysis, which is a very important filter that we should be applying, because a related party filter typically rejects companies which are heavily influenced by their group companies. So the entire ideology of trying to compare with an uncontrolled transaction will be lost if we don't apply this RPT filter. That is, if the entity's revenue is completely influenced by the group entities, or revenue, or the expenses, or whatever the transaction is. If it's going to be completely influenced by the group entities, then what's the point of taking that as an uncontrolled transaction? So we should be applying a threshold called the RPT filter to ensure that the comparable transactions are uncontrolled by the group entities. So I think this is a very important filter that we should consider. We now go to a couple of case studies to better understand how the entire search process works. Here we have company A, which is in the US. They give all the production schedule, and company B, a manufacturer in India, which typically manufactures here and passes it on to its group company as finished products to the group company A. Functions of A typically is requisition for finished products, product design and specification, and marketing and selling of the products. And functions of company B is procurement of raw materials based on the specifications by A, manufacturing the required products, warehousing functions, a little bit of quality control as well, and export related activities. So typically, if you observe here, company A has a major control over the product design and specifications. And it sort of gives a lot of instructions to company B as to how a particular raw material has to be procured, or how the manufacturing process as a whole has to be undertaken. So this is typically a contract manufacturer kind of a model. So here is a quick snapshot of a qualitative and quantitative filters that may be applied to arrive at our final list of comparables. Key quantitative criteria would be we should be keeping companies with a turnover of greater than 1 crore. This is the rationale behind this is to basically exclude any startup companies. We should be excluding companies with a net worth of, we should be including companies with a net worth of greater than 0. That is, we should be excluding companies which have eroded their net worth, which would typically not be comparable to us. Ownership filter, here the assumption is that it's a private company, so we have to exclude government companies to make it more comparable. Functional filter, we should be selecting only manufacturers, the business model manufacturers. And industry filter, we would have to select companies from the similar industry in which the tested party operates. Some of the qualitative criteria would be we should ensure that the group company is majorly involved in instructing the other company in buying the raw materials and converting the finished goods. And if the annual report specifically mentions about contract manufacturing activity that the entity is undertaking, we need to check who bears the risk of inventory typically in the transaction. And since it's a contract manufacturer, we have to try and understand if it's there's a lot of job work income which is being received. And for the RPT screen, typically here for an illustration I've taken as 25%, but whatever would be essential to have as a RPT screen, you can have that as a filter. So say RPT is less than 25% or RPT is less than 10%, or we can even choose to have a comparable which does not have an RPT at all, a reliquary transaction at all. That would be the discretion. That would be our discretion. So this is just a quick snapshot of a typical search summary. So there is a universe of enterprises, say around 10,000 enterprises, entity and at segment level. Here I've applied the turnover and the net worth filters. Because I apply these filters, 909 and 535 companies are being rejected. And based on the ownership, function, and industry, more comparables are being rejected. Qualitative overview, again, this is based on the functional analysis that we have undertaken with the entity and the group. And then finally, we are left with 10 comparables. Ganesh, anything specific you would like to add here?
Yeah. So this is good. I think the objective of developing this search summary, it's extremely critical because what the tax authorities want to see is we've not gone about cherry picking a company. So we've not selected companies, say, just because those comparables show lower margins, or we just like the company, so we selected it. That should not be the case. It should be an objective way of selection. And also where segments are available. So for example, if there is a comparable company which is involved in, say, manufacturing, it is involved in, say, services, and they report two separate segments, then it is ideal to take the segment results if the segment is closer to what the tested party, in this case, the contract manufacturer, does. So that's why this kind of a summary is very helpful for the tax authorities to appreciate that the taxpayer has done a scientific way or scientific approach to selection of the comparables. The other part is, it is quite possible that in the process of selection of companies, as Hiranmai was explaining in the earlier slide, there may be companies which may have abnormal fluctuations in margins. In 1 year, it's say 8%, in another year, it's 25%. And that's quite common because these are third-party entities and they would not have necessarily stable returns. And that may be a characteristic of the industry as well. So again, the answer lies in that question, that when we have such fluctuating margins, is it reflected in the industry overview? Have we covered that in the industry overview, that there are factors that impact the fluctuation? So for example, an industry may be heavily impacted by copper prices. Just because copper prices are fluctuating, the margins will fluctuate. If copper is an important raw material, for my company as well as for my comparables. And therefore, the margins have fluctuated, not just for me, but for my comparables as well. But this is an easier question, an easier view. But there may be instances where you may not have a basis for seeing how comparables margins have fluctuated. And that's fair. You may not have all the information. So if you don't have the information, you don't have any information to reject that company also. So you would need to go with that company and see whether that company fulfills the test of comparability from other quantitative filters and the qualitative filters. Just because their margins are fluctuating and there is no reason to understand that, we can't reject it necessarily. Yes, go ahead, Kiran.
So on the face of it, we cannot be rejecting the abnormal fluctuations. We have to really dig deep into it and then understand why there's a abnormal fluctuation. If there's no abnormality as such, we could consider that as a comparable. Another case study. In this case, it's a service provider, a captive service provider essentially. So there's a group company in US, company A, and there is a captive service provider essentially in company B in India. The US entity requests for support, and the service provider typically provides IT support services to the group entity. This is probably a very common kind of arrangement that we see in our industry. So functions of A would be designing a corporate strategy, designing the system solutions. They would be responsible for this entire supply chain management and sales and marketing functions and quality assurance. And functions of B, typically, if you see, it would be within the framework which is laid down by A, again, in a typical captive service provider scenario. They would be involved in staff recruitment for the local requirements based on what kind of support that the group entity wants. And quality control, again. So basically, the group company or the main parent company in USA will dictate on what your quality aspect should be, what is the framework we need the services to be rendered in. And even bringing in business would be the job of the US entity rather than the Indian entity. So in that case, and in the Indian entity would obviously be involved in general administration purposes. So here, the majority of the risk is being held by the parent entity, and Indian entity here, company B, would become the tested party here, because it's clearly the least complex entity. For a service provider, typically we could have the turnover and the net worth filter, which is common to that of even for a manufacturer. One thing which is specific here would be the R&D filter, because typically for a service provider, as a captive service provider, the R&D cost should be low here, because the majority of the R&D, the design and the strategizing part of it is done by the parent entity or the group entities. So typically the least complex entity would not be doing majority of the R&D function. So we should keep in mind the R&D to turnover filter. Here I've just taken an illustration of 3%. It could be the discretion, it could be 4%, it could be 5%, it could be discretion. Whatever is you find typical is relevant, or it could be comparable. Next one is net fixed assets by sale should be less than 200%. This is again an illustration. So typically we exclude these companies engaged in manufacturing or holding substantial assets. So typically for a service provider, it would be labor intensive rather than they wouldn't be cluttered with a lot of fixed assets. So if the net fixed assets less than 200%, less than equal to 200%, those kind of companies need to be taken as comparables. And for qualitative criteria, we need to understand again the business description of the tested party. Here in this case, it's company B. Certain keywords may be used for search process. For example, say a captive service provider is undertaking BPO services. We should be taking comparables which are typically into BPO services, and instead of taking a company which is into software development or product engineering sort of a business profile. And we should be clearly mentioning about the captive, if it's clearly mentioned in the annual report that this is a captive service provider. And actually in the annual report, generally in a typical captive service provider situation, the entire revenue of the entity would be from the group entities. Probably very, very less revenue from the domestic, if at all they have. But in a typical captive service provider scenario, most of the revenue would be from its group entities. We move on to the third illustration. Yeah, sorry,
Yeah,
the third strategy. Again, a screening of a quick snapshot of the search summary for a captive service provider. Again, the turnover filter, net worth filter, R&D to turnover filter, and NFA turnover, keeping companies which are less than equal to 200%, which assets to turnover filter of less than 200%. Again, ownership based on function and based on segment. And again, a qualitative review, understanding the business, exactly what the business is into, and we need to keep out the comparable companies which are functionally dissimilar. Or sometimes even in certain cases, there might be companies which provide a very broad range of services. So if a particular company is involved into a diversified sort of activities, we should typically not be taking that into account, because the margins that they might earn would pretty much be different from what a service provider would be earning if he's doing just one or two services typically. So that is something that I want to highlight. Anything else to add here, Ganesh, for a service provider?
Yeah, so I think you've covered everything. It's just that we should keep our eyes open to the fact that a service provider, in my case, for example, if I'm an Indian company performing services, I may also subcontract some services. And therefore, there is potentially a possibility of looking at whether the subcontractor is somebody whom I can compare myself against. So that's something which we should also look at. All these search parameters that have been discussed in the last few slides are illustrative. It's not written anywhere in the law that we have to follow this process, and therefore this has to be applied and applied carefully in the context of your own taxpayer and their economic circumstances. That was the only point I had to make.
Okay. Here is a quick illustration. Company A is basically based in USA, is an owner of PQR brand of cosmetics. Company A has entered into a marketing and distribution agreement with PQR brand of cosmetics, Company B, based in India, for Asia Pacific region for a period of 15 years. Company A has also granted an exclusive license to use the brand name PQR and related service marks to Company B. PQR brand is a well-established brand across the world and has continued to earn profits for the group. For use of PQR brand, Company B is required to pay a royalty of 2% of the gross revenues to Company A. For the purpose of benchmarking, CUP was selected. So here are 5 different agreements. I'll just give you a few seconds to go through the data. How should we take this, Ganesh? Give them some time to go through the data.
Yeah, so I think if you can just go through it, we probably give it 30 seconds, and maybe then you can guide us on how you want to do the analysis.
Yeah. So I'll just go by the arrangements one by one. If you see the agreement number 1, the exclusivity is non-exclusive. If you see in our case law, this is an exclusive license agreement which is made to the Company B in India. So in the first parameter itself, it would not be comparable, because in a CUP method, as I told you, the circumstances, the conditions for the agreement should be exactly similar. Then only we could use a CUP method for using that particular comparable. So in the very first parameter, the agreement number 1 would not be a comparable. Again, the region is Sri Lanka, period is 50 years, brand visibility is high, pricing model is 5% of the gross revenue. So the first agreement fails in the very first parameter, because this being a non-exclusive arrangement. If we go to the agreement number 2, exclusivity, it's an exclusive agreement. Region is India, period is 100 years, brand visibility being medium, and pricing model is 1% of net revenue. Here, if you see our agreement for the tested party, it is 2% of the gross revenue of company A. Here, it is net revenue. So in this case, to make this more comparable, we would probably have to make a adjustment. We need to try and understand how much of royalty it would be if we apply it on the gross revenue and check for the comparability in this case. Again, the period here is 100 years. So the period in our agreement, in our case, is just 15 years. So again, that could be a factor in analyzing the comparability of agreement 2. If we come to agreement number 3, it's an exclusive agreement. Region is Middle East. Period 10 years, brand visibility is low. And the pricing model, if you see, it's a staggered rate. For the first 5 years, it's 0% royalty, and for the next 5 years, it's 1% of the gross revenue. So again, this particular royalty agreement is for the Asia Pacific region. So if we check if Middle East would come in the African sort of EMEA sort of set Europe, Middle East, and Africa sort of region. So if we look at it, a particular product might be again the region would be very different in terms of the ideologies of the people, how they would prefer a particular product, how the response would be for a particular product. For cosmetics, if I just to illustrate, cosmetics could be of high demand in a Middle Eastern area, whereas in India, just an example, in India maybe the demand for cosmetics is not as high as compared to the Middle East region. So I think we need to factor in the region in which the agreement has taken place as well to review the comparability. So again, we need to analyze, we need to do a country risk adjustment if required in this case to make this as a comparable. The fourth agreement arrangement is exclusive. Region is India, period of 5 years, brand visibility is low, and the pricing model is again a staggered kind of a price model. So again, even in this case, if we have to make an adjustment, it could be a potential comparable. And for the fifth agreement, it's an exclusive agreement. Region is Nepal, which is part of the Asia Pacific region. Period is 15 years, which is exactly the period of our arrangement of the tested party transaction. Brand visibility is medium, and the pricing model is not staggered. It's a straightforward 1% of the gross revenue. So out of this 5, I would say the fifth agreement seems to be the best comparable. Views on this, Ganesh? On the face of it, fifth one is the most comparable.
Yeah, so I think on the face of it, it looks that agreements, the fifth agreement looks comparable. It will be depending on the economic factors and whether the relevance of the exclusivity can be an important factor, determining the price or the negotiation. And of course, the period of the agreement, whether it's really relevant or influencing the end royalty rate, those have to be discussed in the functional analysis, the industry analysis. That is where the discussion would happen, and your economic analysis would then reflect this in terms of what will be the basis of selection. So to give you the answer, I think on this case study per se, it looks like we have one agreement which looks comparable based on the period, but there may be others which may also be comparable, and we'll have to examine that as well. So that's my take, Hiranmai, and I think we can proceed.
We would probably have to make some adjustments to make them comparable.
Yeah, that's true, but I think practically that's very difficult because we are adjusting a royalty rate, which can be, it's quite sensitive to various parameters. So practically, it can have a lot of challenge on adjustment. If we get a comparable agreement which has a similar term and a similar economic circumstance, then I think it's better to take that as a price. Sure. Can we move on? Yeah.
Yeah. So again, a quick snapshot on the steps that we should be undertaking for benchmarking royalty in case you're opting for a cup method. Step 1 would be to analyze various agreements. Step 2 would be to have a detailed analysis of the comparable agreements. We have to see each and every aspect of the arrangement and see whether it's comparable or not. To try and understand the royalties rates. Factors to be considered again, like in this example, would be exclusivity, the useful life, the geographic scope, stages of development of an intangible, that is to do with the brand visibility. That's to do with brand visibility and rights to enhancement, revisions, and updates based on payment of or expectation of a future benefit. So all these will be broadly illustrative list of things that we should be looking at when we are trying to benchmark for royalty. Yeah, so I'm pretty much done. The final aspect would be there's a decision in our hands whether we would really require an economic adjustment to be made to the comparables. So this is a quick decision matrix. So is there a difference in FAR, the entities, transaction? No, if there's no difference between the tested party and the entities, no adjustment would be required. Yes, if we find out that there's a difference, then whether this particular difference can materially affect the price in the open market. If no, obviously there's no adjustment required. We can take the comparables as it is. If yes, whether a reliable and accurate adjustment can be made. That is an important aspect. If yes, the economic adjustment has to be made to improve the reliability of the comparison. So if no, this particular comparable cannot be selected. If we cannot make a reliable adjustment, the comparable cannot be selected. Again, adjustment can be made in two ways. We could either adjust the tested party or we could adjust the comparable entity. Either way, we could make the adjustment. Here are just a quick examples of economic adjustments. For the credit period, we would have working capital adjustment, accounting policy, depreciation adjustment. That is when the depreciation for our entity and the comparable entities have a different methodology. Say we follow an SLP method or a straight line method. The others might be following our WDV. So to adjust that, we could have a depreciation adjustment. Supply chain, we could have an import duty adjustment. So based on characterization, we would have risk adjustment. Level of operations, capacity utilization. Say, for example, in a particular for a particular industry, it might for a particular entity, it might be in a startup stage. In that case, they would be utilizing only say 50% of their full capacity, full production capacity. So in that case, other entities, other comparable entities would be typically operating in a 60% or a 70% or even an 80% capacity. In such cases, we would have to typically do the capacity utilization adjustment, because only when we make this adjustment, we would be truly, being compared with the other comparable companies. Or else the entire exercise of the benchmarking analysis would fail if we don't make these typical adjustments. So where it is absolutely necessary, we would have to make it. Finally, based on the currency used, we would have forex. We would have to make forex adjustments. Yeah. So I think that pretty much sums up our discussion on the first part of the discussion today. Any final thoughts on this, Ganesh? Any specific things that we should have in mind while doing a search?
Yeah,
or choosing comparables?
Yeah, you covered it exhaustively, and I think each of these adjustments, I think Vaishaka also highlighted them in a way that each of these are extremely sensitive, and we have to apply it with caution. And they have their own mechanics. Today, we do have a lot of rulings from our courts which have delved into each of these adjustments, what is acceptable in which situation. So they can also give us a lot of guidance on how these adjustments could be applied in situations. there are a couple of questions which I'll quickly address, and in the paucity of time, we'll move into the Form 3CB, some key points. But before that, a couple of questions from Sachin, my colleague. So he asks two pertinent questions. One, whether a company having non-routine intangible can be selected as comparable for a captive service provider. A very good question. And typically, when we look at comparables in their annual reports in the balance sheet, they may have disclosures on intangibles. The question is whether those intangibles have a bearing on the price. So these may be exclusive agreements, these may be customer contracts which are long-term contracts, and which therefore may carry a competitive advantage for the business, unlike the, say, captive service provider, which does not have any basis of competitive advantage. So if we assess that that particular intangible has a bearing on the price that is earned by the service provider, then there is a case for not considering them as a comparable. So we'll have to examine that annual report carefully. Second is whether transaction-wise tested party can be selected while preparing TP document. Very good point, very good question. And we should do that if there is a merit to say there is a lesser complex entity which can be tested more reliably. So for a manufacturing segment, there may be a tested party which may be a different entity from the taxpayer. Say a foreign entity becomes a tested party. For a distribution segment, maybe the Indian entity is the tested party. So that's fine. That's perfectly fine because you're testing the right entity for its profit margins, whether that's arm's length. It all depends on the nature of transaction. So to answer your question, that's absolutely understood, and that could be done as well. So those were the few questions, Hiranmai, and perhaps we should move to the next section, and I'll try to make it, keep it short as much as I can. Can you move to the next slide? Maybe we skip the first few slides, and let's go to the taxpayer's responsibility with respect to form number 3CEB. So the form number 3CEB, of course, has a requirement that the accountant, the person who's signing the certificate, is reflecting that the particulars in the annexures are true and correct. So it is important to understand what is the taxpayer's responsibility and what is the accountant's responsibility in signing that form. And that is where the risk arises to the accountant. For example, myself and my friends, when we sign the certificate, we need to be clear what the taxpayer is responsible for. So the taxpayer is responsible for identifying the transactions, which are the international transaction and specified domestic transactions. The taxpayer is responsible for maintaining the records to determine the arm's length price based on the guidance, for example, that Vaishaka set out, and my other colleagues in the yesterday's sessions and the earlier sessions helped us understand how do we compute the arm's length price, the documentation that need to be maintained. So all of these are responsibilities of the taxpayer. And the accountant is responsible to verify whether these particulars are maintained and whether the basis of arriving at the conclusion of arm's length price is in line with the requirements of the law. Then we move. Yeah. And what is the responsibility of the accountant? The responsibility of the accountant, and this is a very significant responsibility where we have to verify that the particulars are true and correct. So for that, we'll have to ensure that the transactions which are reported are reconciled. So if there is a difference between the ledgers and the final financial statements, if there is any difference, we should be able to assess why the difference has arisen. The difference, if any, between the related party transaction schedule and the ledger, if there is any difference between the two, there shouldn't be, but if there is a difference, why? We need to verify the supporting agreements. So for example, if there is an intercompany agreement which says that a related party transaction price has to be based on a certain set of parameters or items, we need to verify whether that price has been computed in accordance with the agreement. For certain methods, we would have to, as an accountant, verify that it has been applied consistently and there's a 100% check. Because when we certify on a cup method, which means that all the transactions or the transaction values which are certified as a related party transaction are all arm's length based on cup method, which means 100% accuracy. it's a good idea to test or just check the earlier year's Form 3CB to see whether what method was applied and how that was applied, so that when we are signing for the current year, we are more comfortable and we assess that the position is being taken. And if there's a differing position taken, fair enough. There is no obligation that we have to follow a principle of consistency. But if there is a differing position taken, there is a merit in taking that differing position. As we discussed, a Form 3CB has to give a true and correct view, and therefore we can't blindly rely on related party transactions scheduled in a financial statement. We have to go into the ledgers and verify that there are no unreported transactions. And there may be, these transactions may be detected by having very simple conversations with the management to understand whether there are any areas where they've had more dealings, more transactions with their related parties related to the prior years. The deemed international transaction is an important aspect because that's not clearly visible from financial statement. And therefore, that requires a lot more investigation by the accountant to verify that these arrangements are, one, reflected in the Form 3CB, and two, arm's length. So that's another important parameter. There are various other aspects, like it's demonstrated in this slide, which is essentially whether we can rely on management representation letter. Our institute's guidance note gives a lot of support and guidance to us accountants to assess what kind of language can be considered in the management representation letter. While the management representation letter can be a letter which could help us guard our risks as well, but at the end of the day, we also need to make sure our duties as an accountant is fully exercised by going through all these documents and making sure that we've done a due diligence of reporting the transactions which have to be reported. Can we move to the next slide here in May? Yeah, move on. I think we covered this, so we can perhaps move to the next one. Yeah, the precautions. I think this is a very important section, and I'm sorry if I'm skipping some slides here, but just in the interest of your time, this is a very important section because as a signatory of the certificate, I need to make sure that I know my responsibilities and the taxpayer knows his or her responsibilities. So it is important to have detailed notes that we maintain as working papers in support of whatever examination we've done on the transactions. We also need to see the auditor's report. We'll have to study it to see whether there are any qualifications to the financial statements, because if there are qualifications to the financial statements, that increases the level of risk of my certification also, to the extent the qualifications pertain to related party transactions. So it is important to pay more attention and more diligence in case there are qualifications. And there are the usual parameters where we have to go by a concept of independence, that if we are appointed by the entity to do certain activities, we cannot take the role of an accountant. It's a question of professional independence that we all have to abide by, and that's something that each of us have to sign up for. I don't think I'll cover any of these more. I think these are all self-explanatory. Can we move to the next one here, May? Yeah. So, so file notes are important. In fact, the current, the form of the certificate, the Form 3CEB, which is electronically filed, gives us option to write our comments and observations as well. Of course, it has a character limit. So if as an accountant, we want to file a detailed note to set out the basis of our certificate or any positions we have looked at to certify, we are free to prepare that note and make sure we are giving that to the taxpayer. And it is natural that if these notes are important and integral to the Form 3CEB, it should be studied by the TPO, the transfer pricing officer, at the time of an audit, because the Form 3CB is a form, and the basis of the Form 3CB is a certain set of parameters that an accountant has used to certify. So it is, of course, the duty of our respective selves, whether we want to explain certain basis of certifying the Form 3C EB. And if that is the case, as accountants, we can take the liberty to have our working notes or notes to the Form 3C EB, which we can furnish to the taxpayer so that the taxpayer may submit it to the transfer pricing officer, either along with the Form 3CB, the hard copy of the Form 3CB, or at the time of an assessment, so that the officer who's reviewing the Form 3CB has the basis of review and making sure that he or she is able to understand the basis of certification of the transactions. Can we move to the next one, Hiranmay? Yeah, so these are, again, very critical questions. And one of the fundamental questions is, can we sign an accountant's report where we have not conducted a TP study? And it is quite possible as accountants, we may get requests for signing the Form 3CB because I think maybe there may be various reasons. Under the circumstances, as accountants, we'll have to have a best effort to verify and validate the basis of the transactions that they are arm's length. It is, I mean, we did cover a certain way of doing the analysis, certain benchmarkings, etc. But there may be situations where you may not have, one, the time, or second, the basis of concluding the arm's length price. The question then to ask is, are we exposing ourselves of a risk of a certificate which is not accurate? And are we putting our reputation at risk as a firm, as a chartered accountant? And that's a question each of us have to answer. There is no one answer, but I'm just saying that as an accountant, we'll have to do our diligence to make sure that what we are certifying, we have the best information and certifying it. And as an accountant, I would encourage all of us to make a case to the taxpayer to say that you have to do this analysis of the transfer pricing study, and we will be able to do it for you. And we should push that bar to make sure that we are able to do a professional work for taxpayers, and they would understand the value of the work that you are doing then. So that's one point I wanted to highlight. Others are fairly, there are questions, but I think in the interest of time, I would perhaps park these questions at this point of time. Hiranmay, can we move? So these are fundamentals where there may be a taxpayer who may not agree with our economic analysis. What should be done? The question is, an accountant issues an accountant's report based on what you believe is the right method, or for that matter, the choice of comparables. So I would suggest there can be a dispute or a conflict here in the accountant's position, and it's best sorted by a discussion with the management and explaining the point of view, because this is going to be an independent view of my friends and my fraternity. And it is but natural that there can be a difference in view between two people. But the accountant has to be able to explain their point of view to the management, and the management should see reason in it if the accountant's reason is valid. So I wouldn't go into that, but these are situations that arise in 9 out of 10 cases. It is quite possible that there can be a difference in view. The question is, as an accountant, are we willing to sign for what the taxpayer is telling us to sign, or would we hold our ground and say, this is the right thing and this is what I believe in and I'll sign? So that's where the difference comes in there, and we have to be strong enough to explain our point of view to the taxpayer. And on judicial precedents, again, it's a point of view that an accountant will have to satisfy himself or herself that these judicial precedents are reasonable to rely on, and therefore will stand the test of time in the future during an appellate process. It's a question of subjectivity here, a question of a matter of opinion of the the accountant, and therefore I leave it to that. But there may be differing judicial positions as well. Go on, Hiranmay. Yeah, I think we've covered this. I'll not get into this, but the only difference is we can't have a management representation letter covering everything in the Form 3CB, because an accountant is expected to do a fair bit of verification. So it is not an abdication of responsibilities that we write in a management representation letter and we are safeguarded. it's only a letter which is a last resort where we have to cover certain things where we are trying to get management's concurrence to a position, or for that matter, a reliance that the management has confirmed certain aspects which we have relied on as well. But it can't be an entire Form 3CB being written up in the management representation letter. That is best avoided, but again, it's subjective. In a particular scenario, you may have to have a detailed management representation letter. But again, we should use it as a matter of exception for specific points which cannot be relied upon or written in the accountant's report. Can we move on? Yeah. So I think this is a chronology of events. This is to ensure that when we sign the accountant's report at the very end, we are comfortable with all the previous documents. A Q and RM means quality and checks on whether, one, we are independent to issue, whether we have done the work in a very, upholding the quality of our profession, the quality standards of our firm and us as accountants, and of course the other aspects which are preceding that. So that's really the chronology that is a good practice to follow. So with this, I will conclude my discussion on this. And the accountant's report, as we said, it may be one certificate, but it carries a lot of value. So I would encourage all of us to safeguard our interests and our risks in certifying the accountants. Thank you so much for your time, and thank you to our friends and the organizers and the SIRC branch. And thank you, Mr. Panindra and Ravindra sir, for giving us the opportunity to share our experiences and share our knowledge with my friends. Thank you.
Wow, what a session it was, sir. So it was fully power pack session. So all the three expert speakers dealing with transfer pricing, so have done their job and with given time. So thank you so much once again on behalf of Bangalore branch. So CA Vaishaka madam and Ganesh sir and Hiranmaya madam. So and hopefully we look forward for further deliberations in future also. And keep supporting Bangalore branch. And thank you so much once again for all the viewers who have attended today's session.
Thank you.
And before we conclude, so upcoming events in Bangalore branch. So on 25th, next Wednesday, so we have exclusively Tally Prime product showcase. Like Tally has launched recently Tally Prime. So to explain this one difference between ERP and Prime, so we have organized this event. So and this seminar also will be very helpful for all the practicing chartered accountants as well as who are in industry also. And next one on 26th Thursday we have IBO transition. So what it means and why it matters. So keep listening to Jnana Dasoha and enrich your knowledge. Thank you once again, one and all.
Thank you.
Thank you. Thank you so much.